I apologize. I'm chewing gum. Hopefully, I'm not like smacking too loud. Lots of interesting stuff going on. Tech stocks pulling back a little bit. Not a bad thing. Little quiet though in general. I'd say a little quiet in the market. I think people are trying to enjoy the end of the summer. Nothing too crazy. I heard someone came out and said S&P 500 is going to hit 6,600. OMG. And of course, I do the Tesla video, and now it's up um, almost 17 bucks. Not because of me, that's for sure. All right. So, waiting for all the friends to join, get the party started. Working on this week's company. It's one that we covered before, and I figured it would be overvalued. It's actually not. So we shall see. I was kind of disappointed that the Tesla video didn't take off more. I thought that would have been fire, but everybody gets offended. I don't know, Elon Musk. It's like everybody gets offended. I just don't get it. And then with the algorithm, like if you get a downvote, it's basically like dead in the water. So I think like 2 downvotes like right away. It's like so it'll take a little bit of time. Duh, live stream chat. All right, hey, what's going on, man? You got here early tonight. You didn't want to miss anything. I appreciate that. Last time you were here, you're asking about United Healthcare. I covered it like right up front. Everybody was going bananas with it. But yeah, fire away. Anything you want to talk about? We're live. I was just talking about the algorithm and how Tesla. Obviously, everybody gets all jacked up about Tesla. Elon Musk, the all the insanity with that. See, the thing I don't understand, someone has to explain this to me. Like if you don't want to invest in a company, don't invest. I don't get it. Or if you do want to invest in a company, invest. Go right ahead. I don't care. But it's just like it's nuts the way people react to this stuff. It's bonkers. I didn't know like stocks became like politics. It's just like so weird to me. It's numbers. It's just like it's bizarre. Yep, Ken not wearing a suit. I'm like finally like not working for the first time in like 2 months. So I'm just kind of in more of a chill mode. I got the blue going though. Gotta rock the favorite color. But yeah, me not wearing a suit, wild stuff. Still professional. Don't worry, still the same guy. Um, but yeah, with the Tesla video, oh my gosh. One guy I'm gonna cover. I'm gonna wait for a few more people to join. The one dude that's like, I'm unsubscribing from your channel. I was like, whoa, relax, bro. Um, yes, I agree. People who mix politics with stocks won't end up a winner unless I'm waiting for someone to say, unless you're Nancy Pelosi, then you will be a winner. Or frankly, anybody in Congress. I know that there's like there's a few websites that track it, and I think someone said that they were coming out with an ETF that was going to follow the stock trades of like people in Congress and the Senate, which is just bonkers. But it's true, like they all outperform. My representative is Josh Gottheimer, and like he made like $4 million last year from stock trades. I don't know how that's possible. Like he made an insane number of trades. It was just like absolutely, like literally unbelievable. Maybe we'll pop into that. That's just like ridiculous. Yeah, I'm one video away from pitchforks and torches. Yeah, no doubt, man. I want to cover that though. I want to show you guys the comment. Like it was just so bizarre. I'm like waking up, I'm like getting ready for work and stuff like that. I'm like, oh, let me see how the video is doing. There's one dude went absolutely bananas. It's like, I'm unsubscribing from your channel. You have false hope with a DCF. I'm like, what are you talking about? Oh my gosh. So Proud said I have a watch list of Pelosi. Amazon call a year out. Pelosi was actually very early on NVIDIA too, which was another interesting one. Yeah, doubled down with another Tesla video this week. The whole like the whole channel, everybody would just leave. It's just like so crazy to me. I don't get it. I gotta show you guys the comment. I already have it like up. I just have to share the screen. because it was like so bizarre to me. I was like, I had to reread it, and a couple of you came and defended yours truly, and I appreciate that. But I was just like, it was just so bizarre. I gotta share it. So enough talking. Let me share this. This is just bizarre. Okay. So be prepared, friends. This is gonna be like the weirdest thing you've seen in a long time. All right. So I got the video comments up. All right. So, and I invited the guy to come on to our lovely live stream. I was like, bro, like, you want to like hash this out? Come on to the live stream. Literally invited a few hours ago. No joke. So the invite's right down there with the link. So he said, how can you defraud people? What? By believing, spreading lies. Yeah, there's like obviously like a language barrier here too. To people about investment opportunities on Tesla at this kind of a price tag. Now, if you look at the thumbnail, it says buy at 329 question mark. And if you actually watch the video, I don't say buy. I say it's a hold. I say buy under 300, but we'll just let that hang in the air. Tesla can't grow because they need to spend more to grow more. They're spending on maintenance capex. I don't even know what that means. Almost destroyed their cash for reinvestment for the future. I don't even know what that means. They're spending more on maintenance capex than... Okay, so anyways, we'll just continue. Tesla can never be invested using a DCF, but only as net tangible assets. So just so you're aware, in like a bankruptcy scenario, when you're looking at a company and it's like dead, okay, like it's no longer a going concern, what you do is you say, okay, 100% of the cash, 75% of the accounts receivable, 50% of the inventory, and then you just subtract all the liabilities. That's net current asset value, net tangible assets. So that's the way like you would look at a company that's bankrupt. You can't value any company in the S&P 500 with that methodology. But moving on, you don't lie about being financial professional or something. Your video on the intrinsic value, again, I don't know what that means, about Tesla is straight up a fraud. Okay. Like I invited this dude onto the live stream. If Tesla needs robotics, they need to invest more. Yeah, it's called capital expenditures. Their net cash by $31 billion. What are you talking about? Their FSD is not making money. It literally it's just rolling out now. The first FSD car was ever delivered like a few weeks ago. What is he talking about? Eventually their cash flow would still be relatively low. And if they fail to dominate the industry in robotics, their cash flow will go negative, regardless which way you look at. Stop providing the false hope for the Tesla investors that is looking for hope that is not realistic. Like, I don't know what happened to this dude. Like, maybe he got hit by a car and it happened to be a Tesla, or like his wife left him, and when she drove away, she was driving away in a Tesla and gave him like the peace sign. I don't know what is going on here. Like, it's just like bananas to me. So yeah, my response, the first part, you need to chill out, bro. Like, what? Like, what is this? Defraud people? Yeah, the thumbnail's a question, not a statement. If you watch the video, which you didn't, I don't have a buy rating on the stock. DCF, you can't use the DCF net assets. DCF is used for a going concern. Net asset values for bankruptcies. Every single analyst on Wall Street is using a DCF. Dumb. Fraud? Tesla's a fraud? Please show me the evidence. I think the SEC would love to know this. I don't know why you're so angry. These are numbers and math. You gave no calculations with any of your arguments. So like he's saying like, they don't have the money, there's no cash flow. Like, I'm like, just like, huh? I was just like so confused by this. And not only that, I'm like waking up, okay? Didn't even have a cup of coffee. And I start reading this. I'm like, what is going on here? This is just bizarre. Like, what the heck, man? Chill out. People need to relax. What is going on here, people? Just like, what? All right, back to the chat. Yeah, false hope. What? Yeah, Tesla options must have cooked them. That's right. So John, is Uber still a buy? Let's show this on the screen. Uber still a buy? Question mark. Let's go see what Cap IQ says. Let me go pop into Cap IQ. Where is my Cap IQ? Hang on. Bear with me a moment, friends. All right, I'm going to find Cap IQ. Where did you go, Cap IQ? Full disclosure, I have way too many things open on my screen, um, but that's okay. Let's find Cap IQ. Where did you go? Here you are. Let's check out Uber, and then I'll share the screen. UBER. No, 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 no. All right, so I'm just going to like pop up the CIQ estimates. So no, it looks like they got them ranked as an outperform. Hang on, I got to go back and forth here. All right, here we go. Share, screen, Uber, boom. All right, yeah. So this is this is Cap IQ. Huge fan of Cap IQ. So Cap IQ gives us a really good kind of picture of how everybody's looking at, everybody on Wall Street, that is looking. There's 48 analysts that cover Uber, 95.16 today's close, the range 82 to 150. And if you look, 1.58 outperform. So based on what Cap IQ says, they're still a buy. But let's see, the median 108. Let's do the math because you want a 20% discount. Let's just take the median as accurate. 108 divided by 1.2, 90. Yeah, so there it's a hold right now, based on what Cap IQ has. So yeah, people are crazy, man. I don't get it. Yeah, I mean, I just like don't understand like the banana fest. It's just like I don't know. It's part of it is like people, but like I don't know what possessed him. Like I don't know how it came up, but it obviously came up on his feed, and he just went like batshit. I don't get that, dude. It's like relax. You're defrauding people with a DCF. I mean, if you really want to go nuts, Dan Ives. So Dan Ives, Wedbush Morgan, he is like the tech guru. He's one of like the big tech equity research analysts. Dan Niles is another one. So Dan Ives has a value on Tesla of 500. I'm not even including robots or anything like that. I didn't even include anything like that in the valuation. But he's got a value of 500. So if you want to get pissed off at somebody, go talk to Dan Ives. Ooh, this is a good question. How do you feel about Texas opening their own Wall Street in talks of 24-hour trading? I personally, I think it's great. You know, I think it's going to make the market, you know, more efficient. 24-hour trading. I think also, you know, the benefits for companies that are planning on going public, they want to go public in Texas. So I think it's going to be, you know, will it be the next Wall Street? I mean, you've got to move all the companies that are in New York down there. I don't see that happening anytime soon. You know, there's a lot of tech down there in Austin, especially. You know, but they could kind of do like a little carve out. There's multiple exchanges out there across the United States. It's just the New York Stock Exchange is kind of like the one. But there are other exchanges out there. So I think 24-hour trading would be interesting. That would definitely make the market more efficient. But you know, you see like moves after hours. I'd be curious to see what impact that would have on like earnings calls, because a lot of companies, they'll do them when the market closes. So you'd probably, I think over time, you'd probably see less, pop or less reaction. You know, when they have like they beat, because the reason why stocks trade like up significantly or down significantly is there's like no volume in the after hours trading. So I think it would just be like more muted reactions. So our friend Seba here does not like Dan Ives. He's got the clown on Dan Ives. He definitely dresses in a very wild fashion. If you see him, he's got like pink suits and he wears like chartreuse and stuff. Interesting guy. But I think when you're dealing with technology, it's a totally different ball of wax. And you know, to specifically invest in technology and have that as your focus is just so hard, because you're looking at TAM, like total addressable market. So I think they pegged humanoid robots. The market potential is 7 trillion. and self-driving cars, the market potential is 13 trillion, I think, both by like 2050. So those are like pretty huge markets. You talk about the United States, right? 30 trillion in GDP. So if you add those two together, that's 2/3 of the whole GDP of the US. Obviously, in 2050, the GDP will be significantly higher. Um, but it's just wild to me, like people's reactions and stuff. I mean, all a DCF is you're projecting into the future, you're discounting cash flows back to today. There's no real like controversy with that. And it's a guess. That's why you do multiple cases. So when I run my models on YouTube, it's a base case. So it's kind of like more of like a consensus type model. It's not like I'm trying to juice up the numbers. If anything, I always go lower. So I go lower on revenues, higher on expenses. So I get a conservative number. So if, I end up having a rating like based on the model that it comes out to be a buy, it's based on super conservative estimates. You have no incentive to try to like come up with these ridiculous numbers and stuff like that wouldn't help you. It's like, why would you put like a 50% growth rate on a company? You would get some like crazy answers. All right, so any thoughts on GEV? Let me put this in the chat. Zing. So I don't know if he's here yet, but we definitely have a big fan of GEV. But let me pull up GEV on CapIQ. GE Verona, there you go. And when he comes, he'll definitely opine way better than I would, because he's an investor. But let me share the screen, and we could see the Cap IQ for GEV is GE Verona. So another one, 1.88 outperform rating there. 27 analysts cover it. It's a spinoff of GE, of Vernova. I said Verona. I keep thinking of Verona, New Jersey. So it's at 602, 685 median. So it's still a hold. It wouldn't be at a full 20% discount. But I mean, this thing is just absolutely ripped. And then in general with stocks, so another thing too is this something you'd be willing to hold for the long term? I never look at things, in general as short term. Sometimes there's like satellite plays where you're not going to hold them forever. But is this something that you would hold forever? And do they have, massive market potential? Like if you scroll down a little bit, they're at 34.9 billion in 2024, 54.7 billion in 2029. I mean, that's pretty significant over that time frame. So they're growing at a decent clip, and definitely a good rating there. So I would say it's one to check out and look into. I think they make like turbines, stuff like that. So if you think about it thematically, one of the ways that you would want to think about like what to invest in or what to even look at is, think about the future, obviously. But then people are AI, and it's like, okay, calm down. But one of the themes that we are all aware of right now is energy, right? So we're going to need, if we're going to power AI and chips and all of this stuff, we're going to need the infrastructure in order to do that. So any company that would support that infrastructure build, like a GE Vernova, they're going to benefit. When a stock has ripped like that, you do have to be careful because sometimes it gets ahead of itself. Look at Tesla, for example. I know it's like a, bad word, can't even say it, but Tesla hit 488.54 in December. Like anybody with half a brain was like, what the heck is going on? Like I knew it was ridiculously overvalued then. But sometimes stocks catch momentum and they just start ripping. Like a lot of like when we cover SoundHound or SOFI, those tend to have pretty significant short positions. So anything positive that happens, it'll cause a short squeeze. So people will cover their positions. And when that happens, stock can just like rip 10% in one day, 20% in one day. And people are like, oh, what happened? It's a short squeeze. They're just covering the short squeeze. Like GameStop was like a very prolonged short squeeze. that was probably like the classic example that everybody can remember. But there's previous examples of short squeezes that are just ridiculous. Like a double or triple in a single day. That's not something to invest in. Obviously, if you're just kind of trading, you could take advantage of that. But it's definitely very, very risky. But GE Vernova, we talked about Sterling Infrastructure, STRL. They actually build out data centers. So that's another area that's going to be pretty big. I guess the question that I have with all of this stuff is, okay, once the stuff is built out, then what? Right? So you think about like chips. So full disclosure, semiconductors, that whole industry is a cyclical industry. Okay. It's not like, you know, it's not the type of industry that you would invest in long term. Like you kind of get in early cycle and then you exit late cycle. Right now, we've just had an obvious boom because of AI. But in general, like everybody, like every other day, someone's like, could you look at this chip company? Could you look at that chip company? It's like just because it's chip or AI doesn't mean it's just going to go up and to the right forever. I mean, that's just like kind of crazy. But you have to think to yourself, like, when's this going to level off? All the Mag 7 companies that are allocating all these capital expenditures for artificial intelligence, it's pretty much 25, 26, and then it's going to level off in 27 and go to more normalized levels. That assumes that everything's like built out by that time. I don't know if that will be the case, but it kind of remains to be seen. So we'll see. I'm definitely like positive on AI and where technology is heading, but some companies are going to benefit more than others. The more recent trend that you could look at in this regard is electric vehicles. So if you look back like 2020 and 2021, I mean, EV was just going bonkers. But the limiting factor is the infrastructure. You need the charging capability. I always like tell people when I'm doing my trainings and stuff like that, my cousins live in Indiana and like it's hard to get gas out there. So the idea that EVs are just going to like take over there is challenging, especially if you're driving long distances. Like you're talking about people that are literally packing a cooler with ice in the back of their, Suburban or SUV to go food shopping because they have to drive like over an hour one way so that the food doesn't perish. Like no joke. All right, we got Pratyush weighing in here. Views on offshore drillers. No new rigs are being made and the day rates are trending up. That's another one that's very cyclical and directly tied to oil prices. So dry shipping, those types of companies are also very cyclical. Drillers are cyclical. But I see what you mean, like the capacity issue. This is actually why Warren Buffett was very bullish on railroads, and everybody kind of missed the boat on that. But if you think about it, just brute logic, they're not laying any more train tracks. So there's a massive advantage that the limited number of players have because they own the infrastructure. It's already built out. Like that's not an area where anybody's entering. It's kind of like airlines. It's a very difficult, like massive barriers to entry. You think about like a Porter's five forces type analysis. Very difficult to enter an industry like that. I mean, offshore drilling, like the rig, the build out of it, stuff like that. So I would say when, oil prices are higher, they'll do better. But then when they come down, you have this glut. It was interesting. My former mentor at Deutsche Bank, I had him speak to a bunch of my coaching clients last week. And he was talking about like, someone said, like, what's the craziest deal you ever worked on? And he gave the example of a company that was being bought out as an LBO. And it was an oil and gas company. And whenever you deal with debt or credit in general, you run like a worst case scenario. So you run kind of like a base case, downside one, downside two. Downside two is like the world is coming to an end. So they ran the downside two case at like what's the lowest oil prices have been in the last 50 years. So even in that scenario, they were okay. Well, what ended up happening was there was this massive supply glut He said it was so bad that there were ships off the coast that had containers full of oil and they literally couldn't drop it off on shore because there was so much supply on shore. When stuff like that happens, they just stop drilling. They're just not going to drill anymore. So what you have to do, whether it's offshore drillers, you know, on land discovery, shale, whatever it is, they always have some sort of like a break even point where once it falls below that, it's actually costing them money to drill. And, you know, it tends to be like the $55, $60 a barrel range. So above that, it's worth it for them to produce. But below that, like for every, you know, literal gallon that they're pumping out of the ground, they're losing money because you think about it, like variable costs, you have to hire the people that are going to, you know, actually pump everything out of the ground. It'd be the same thing with the offshore. So that's the challenge. It's very much predicated on oil and where oil is at. So I would say if oil is trending up, that would be a good area, but it wouldn't be like a long-term investment that I would focus on. But in the short term, yeah, it could pay off. That might be something that, you know, offshore drillers, you might look at like options, you know, an options play, something like that. I've done that before. There was a company, I'd have to look back and see, but there was a company that I had found that was after COVID and they shipped energy across the Great Lakes. Like that was their business. And they were super undervalued, but I didn't want to like take a position. So I ended up buying long dated calls and it like tripled. It was crazy. All right. So we got another one on GEV here. Huzefa. I want to know too. What are your thoughts on GEV? So again, I'll show the Cap IQ. You know, I don't have like a feeling one way or another. I think long term, you know, definitely going to benefit. You don't want to overpay, but this was the overview from Cap IQ. So this is basically what Wall Street, you know, the 27 analysts that cover them, 280 the low, 760 the high. I always look at like the mean and the median. So obviously the median's higher, so it's skewed towards the higher end. So if you just want to figure out like is it worth, you know, piling into without doing like a DCF and stuff like that, just take that median number 685 and divide it by 1.2. That'll give you a 20% margin of safety. So 571. Below 571, you'll have a 20% margin of safety. Again, if you believe what they have here is the median estimate. But again, you know, what are they focused on? Energy, turbines, infrastructure that's going to be very much necessary for all this build out that we're talking about, data centers, AI, and all the energy that's required. It has an outperform rating, but it's also ripped as well. So again, I'm not like one way or another. It definitely seems that it's closer to being undervalued than it is, you know, overvalued. But I haven't personally like dug deep into it and done, you know, due diligence and stuff like that. All right, so good question here. I'll pop it up so that everybody could see it. How do you go about predicting oil prices other than OPEC meetings? So oil prices, you'd have to look at the futures market and see which way it's trending. This kind of is funny because I remember back in COVID when people are like, oil is negative. It's negative. You could literally buy a barrel and the barrel's worth more than the oil. And it's like, no, dummy. It's actually a function of the futures market. So what would happen is if you locked in a futures contract pre-COVID, you were losing money on that contract. And basically the way that futures work is you lock in a price in the future to buy or sell. So if you were selling, you have a short position, you're killing it because oil was basically, you know, zero for all intents and purposes. So you're selling it at 60. The person that was buying it at 60, they were losing their shirt. But the futures market is it's different than forwards. Forwards are unique, but futures, you know, you have like the Chicago Board of Options Exchange, and you have the central clearing party in the middle that makes sure that the contracts are actually going to be fulfilled. and you have to have, membership on the exchange and all of that stuff. But that's how you would look at it. You would want to look at the futures market. That would be where you'd want to see where prices are going, because that would be a better proxy than if you were looking at like OPEC meetings and stuff like that. But again, every single company will, they'll explain in their earnings, every oil and gas company will say where prices have to be in order for them to break even. And that goes for countries as well. When you look at, a lot of the OPEC countries, they want to limit supply so that they could increase the price, because what they do every year is when they create their budget, and they're actually like looking at, because like like Dubai, they don't have any like income taxes. People are like, how's that possible? And it's like, well, if you think about it, their whole budget is based on oil. So as long as oil is above a particular level, they're going to be in good shape. So you actually have to look at that. You have to see kind of what they ran their budget at, and it's a pretty good proxy for where prices are going to be. All right, so sorry, I wanted Vista. It's an energy stock. It's compared to GEV. Okay, let's go check out Vista. All right, so I don't know what the ticker is, but let me try Vista and see what comes up. Vista Equity Partners, Vista Credit Partner. Vista Energy. That's probably the one. All right, so let's check out Vista. It looks like it's not trade, or maybe it's an ADR. But let me share the screen. Let's check out Vista. All good. All right, Vista Energy. Here we go. All right, so Vista Energy, very under followed from an analyst perspective. That's actually a good sign when you see that the company is not well covered by analysts. That tends to actually be a good sign. So there's 2 that follow it up top. Oh, and then the NYSE 10 that follow it. Yeah, latest close. I'm getting, okay, so the ADR 3888. So then you have to compare that to the top. Wow, median 6514. Yeah, that's like that's like bye. Yeah, so it's, I mean, personally, like I've never seen on Cap IQ any stock that has a 1. Even if it's, a very solid stock, it'll be like, between 1 and 1.5. But this is like, Kramer hitting the buy, and the bulls go everywhere. But again, this is not one that I'm personally familiar with, but Pratyush says, Nancy Pelosi owns Vista. You're in good hands. That is a very good proxy. That is a very good proxy. But yeah, this looks like a diamond in the rough. So I'll show that, Nancy Pelosi owns it. You're in good hands. This is true. She has a better track record than any hedge fund. That's for sure. Yeah. So Giovanni said, as I get older, the more I realize how insane COVID was and its impact on so many industries. Truly a black swan event. Yeah, but the thing that you want to think about with a COVID, it's funny. When I was at JP Morgan, I guess it was like 3 weeks ago, Jamie Dimon spoke. And the funny thing is, when people think about like, wow, what is Jamie Dimon reading? He's a billionaire. Someone asked him like, hey, what are you reading right now? And you're thinking like, oh, he's reading about AI. He was actually reading a book about the Great Depression. So that's something that I find, with like a Jamie Dimon, a Ray Dalio, Warren Buffett, his former partner, Charlie Munger, they're reading about stuff in the past, and they're seeing, if there's parallels to what's going on today. So that's something to just keep in mind. So yeah, I think it would definitely be worthwhile to look at books that were written about COVID and what happened and market shocks in general. That'll definitely make you a better investor. So yeah, so I addressed this a few minutes ago. So oil didn't actually go negative because people are like, you could literally sell a barrel, the barrel that the oil is in, for more than the oil. So I was like, no. So basically, it's called a futures contract. So a futures contract, you lock in a price in the future. Okay. So you lock in a price in the future, let's say 60. All right. So I'm going to sell at 60, you're going to buy at 60. So if I'm selling at 60 and the price goes down, I win. Okay, that's what's called you're short a futures contract. When you sell a futures contract, you're betting that the price will go down. If you're long a futures contract, you're betting that the price will go up. So think about it. If 60 is the number, if the price goes up, you bought the contract, you locked in 60 to pay 60, and it goes above that, you win. All right, so you're long the futures contract. But if the contract's at 60 and you're selling, okay, and the price goes down, that's how you win. So that's why they say long or short a futures contract. So the person that was selling at 60, they were loving life. The person that was buying at 60, they're paying 60 when oil was like, in the single digits during COVID. That's what they meant by oil going negative. So it didn't actually like literally go negative. It was based on futures prices. So that's what I was saying a few minutes ago to Pratyush. If you want to get a proxy of how oil is going to perform, there's people that are spending millions of dollars locking in futures prices. So if you see what the futures prices are, you'll see if they're trending down or trending upward, and that will give you a very, very, very good perspective of where oil's headed. That would be way better than like an OPEC meeting. That would be the best way of looking at where it's trending. So that's what they meant when they said like oil went negative. It didn't literally go negative. What ultimately happened was, from a futures contract perspective, if you're buying your long oil at 60 and the price goes down, your position is negative, because effectively you're paying 60 for something that's now $10. So you're negative 50. So when they said oil went negative, they were referring to futures contracts, not like literally the cost of a barrel of oil. Yeah, it was like $10 a barrel, but it wasn't negative. Like no one's going to like pay you to take their barrel of oil. Like that didn't happen. But that's what the mechanics are. That's what they meant by saying oil's going negative. Yep. And then everybody, like a bunch of people are reaching out to me asking about Powell and the quarter point. I mean, honestly, quarter point is not really going to make that big of a difference. A quarter point cut, I don't think that makes that big of a difference. Now, the market, the Dow was up like $800 when Powell kind of alluded to the fact that, it looks like we're going to, or would be open to cutting. So that's one of those things where it's like, oh, but again, in the grand scheme of things, it's not going to have a major impact. Now, if they kind of alluded to, 5 quarter point cuts, that would be more significant. But it'll be interesting to see how the market reacts to a quarter point cut. Good question. Really getting into the weeds here. If you were a hedge fund manager, would you be more inclined to look into cyclical sectors to generate alpha? So cyclical sectors always tend to be tough because you'll know where you are in the cycle. You just won't know when the cycle is going to end. So you could look at, historicals to get a better perspective. But, there's so many different industries that are cyclical. Like people don't realize recreational vehicles. That's a cyclical sector. Semiconductors, by the way, everybody, it's a cyclical sector. And it's like, how could that be? NVIDIA's gone up so much. It's like, relax. If you look like AMD and Intel, like it's a cyclical business. So they go up, they go down, they go up, they go down. So you want to try to time a cyclical low, and then, get out when it's high. But like, you're not going to be a happy camper if you just like own, one of those chip companies, for 40 years. You'd be better off just investing in the S&P 500. So, I would say the biggest thing to your question, Pratyush, to try to generate alpha as a hedge fund manager, you have to kind of think about it as like short versus long-term alpha. I'm always a big fan of time horizon arbitrage. So I vividly remember it was like 2006. So this was like right before the financial crisis really was cooking. And I was flying into Miami and I saw all these buildings, like you could see through the building. So they had built the building, but they hadn't finished it. So that was kind of like my first clue. I was like, huh. And it's like they're not making any more real estate right on the coast in Miami. So I was like, this is kind of interesting. So I thought to myself, in hindsight, like if you could get a bunch of people together and say, hey, we're going to create a fund, there's a 10-year lockup, we're all going to invest. I mean, you'd make an absolute killing. So I'm a huge fan of time horizon arbitrage. There's a lot of things that you could say 5 years from now, is this going to be better or worse? But the short term, which is the challenge with hedge funds, that's the real key, because hedge funds, they're looking at it like on a month to month basis. That's the difficulty. So Loco, what are your thoughts on kindercare? Um, so it's interesting because like this is where you have to think of different trends, right? So you have a lot more people working from home, so there's less of a need for that childcare. You could kind of take that perspective. You could also take a different perspective where it's like, hey, my kids can get educated and taken care of while I'm working and being efficient and getting stuff done. Um, I have a few people that I've come across over time that have invested in KinderCares. It's a franchise. I think if you were going to invest in an individual one, you'd want to be very, very, very cognizant of the market and like really, really on top of the market that you're in. So I would say if it's a place that's building out, like we were talking about it earlier, Austin, Texas, right? So you have a lot of people moving there, people starting families young, like that would be like the prime place for it. I think it would be more of a challenge if there's like a mature market, but thinking about it in terms of like a stock, I mean, it's kind of crazy. I think in the United States, we're below replacement rate in terms of pregnancy. You have to be like, I think above 1.8, and we're at like 1.2, something like that. So a lot of people are getting married later, if at all. Not as many people are having kids. So I think that's something that would be more concerning for a business like KinderCare, is just like the demographic trend. So if you look like World War II, right? Everybody's coming back from the war. They're getting married. They're having babies. Like that would be perfect. Like, KinderCare, real estate, all of that stuff. I'd be a little bit more concerned. You could do like a poll of, the people that are here, how many people are getting married and having kids, and people are like, so that's the thing I would be more concerned about with a KinderCare, is just kind of like the future market growth with less and less people. I mean, like Gen Z is notorious that they're going out less, they're dating less, they're doing a lot less of everything. So I'd be kind of more concerned from that perspective with a KinderCare. I own SPGI. I know. Oh, let me put it on the screen. Okay, I own SPGI and always wanted to ask a user if Capital IQ, Commodity Insights, and Market Intelligence are worth the money. Are they good products? Um, it depends how much you invest. It's like 25 to 30,000 per year for the license, so it's kind of, it'd be like having a Bloomberg. So yeah, it's very expensive. I mean, look, I would say to justify Cap IQ, you'd have to be, making it your business, if you catch my drift. That would be what I would say. But if you're kind of like casually, investing and stuff like that, I mean, I'll show you guys one that I really like. I have it up somewhere. And again, I'm notorious for having way too many things open. So I apologize, but I'll pull it up and I'll show it to you guys. This is one that I've been a huge fan of for a long time. And let me show the screen. It's Finviz. I'm a huge fan of Finviz. It has a surprising amount of information for something that is free. No, I don't want to add a Chrome extension. So this is Finviz. So they have pretty much, everything that you could want. I mean, I'll just pull up the infamous. Don't close your eyes, kids. Tesla's coming at you. But I think for something that's free, I mean, this is pretty darn robust. If you're into charting, which I'm not, you got the moving averages and all that stuff. You look here, right? You have every multiple and metric that you could ever want. right there in front of you. And then if you go down, you want to see what Wall Street thinks about something. Man, these freaking advertisements, they're like attacking me left and right. Jeez, the freaking wees. But you see right here, this is pretty interesting, right? So you see the recent ratings. If you click, you can see previous ratings. So you see kind of how they've changed over time. These are all the relevant news articles that you could ever want. Let's see what else is here. And then they have some limited financial data. Again, I would never advise that you take, like, I don't use the financial data from Cap IQ. I try to see what Wall Street thinks, but I'm always grabbing the actual numbers from the financial filings. But if you look right here, I mean, for something that's 100% free, I mean, look, insider trading. I think Finviz is like the best bang for your buck, considering it's 100% free. That would be what I would advise checking out. Check out Finviz, and it's just Finviz. That's what, before I was using Cap IQ. I use that all the time. I mean, I still use it, but that's what I would advise. I wouldn't advise like spending a ton of money. Look, the data is phenomenal, but unless you're doing it as like a professional, like if you tell me like, hey Ken, I got $10 million, and I invest on my own, that's what I do for a living. Yeah, definitely get Cap IQ. It's worth every penny. But Finviz is, I think, for free. That's the best thing that's out there. And yes, I 1000% agree. The Finviz screener is absolutely incredible. The amount of information that you can get. Now, I remember when I was using it, maybe a year or so ago, you had to like pay. You had to pay to like download the data into Excel. That was kind of annoying, but it's very good. I would advise Finviz before you go to Cap IQ. But maybe one day Cap IQ will sponsor my channel in the live stream, and I'll say, "Hey, Seba, you should be buying Cap IQ. Don't waste your money on Finviz; it's free." All right, so let's see this. Saw a stat, not sure if true, but when S&P trades at 23x or higher, the next decade returns are between -2 and 2%. Would you still, Howard Marks is extremely bearish, would love your view. Okay, so this is an excellent question. So let me pull it up. What we're talking about here, friends, is the CAPE ratio, the Shiller PE. All right, so I'm going to pull it up. Okay, so this is important because you'll hear people go bonkers on this, but I'll explain kind of the good, the bad, and the ugly with the Shiller PE ratio, where you do have to be a little bit careful. All right, so too many windows. There we go. Shiller PE. Okay, so if you just Google Shiller PE, you'll be able to pull this up. It's multpl.com. Okay, so this is named after Robert Shiller. So this is the CAPE ratio, which is also known as the cyclically adjusted PE ratio. Okay, so the way to look at this, if you look historically, 16 is the average. So you look right now, it's like, oh my gosh, the market's overvalued, short the market. So I would caution that, because when you look at the last, it's 140 freaking years that it's going backwards, you have to think back, all right? So think back to like the late 1800s, the early 1900s. You're talking about like the sexiest companies back then were, I'm not joking, like radio companies, like, whoa, railroads, whoa. And then there was a thing that was created called the automobile, whoa. So to try to compare today's market, where you have very high growth, lot of tech. I mean, right now, 1/3 of the S&P 500 is tech. And if you look at the Mag 7, I think the PE ratio of the Mag 7 is like high 30s. So that's really skewing the overall PE ratio. And again, I'm a huge fan of Howard Marks, Oaktree. Like, go look him up. Like, brilliant, absolutely brilliant guy. But I think where people are missing the mark with this is you're not accounting for the tech the tech weight and the tech influence on the overall PE ratio. I remember this was years ago, so I don't know if it's still relevant, but McKinsey did an analysis. If you remove tech from the S&P, the S&P was at like 15, 16 times. So it's kind of an apples and oranges comparison, truth be told. I don't think it's the best proxy of under or overvalued. There's another guy, GMO Investors, another great investor, Jeremy Grantham. He's a value investor, and he's been negative on the market, I would say, for probably like pre-COVID. So I'd say probably 8 years. Like we're gonna have black swan crash, the whole like he's been like super, super, super bearish for a very long time. The problem is that that thesis has not borne out. I mean, if you look since COVID, the market is just absolutely ripped. Obviously, yes, what goes up must come down, da da da. And then you see other statistics. When I was at JP Morgan, they had some like really fantastic statistics. It was like if you removed the performance of the Mag 7, like, or it was if you remove the performance of like the top 50 stocks in the S&P 500, like the bottom 450 were negative. So it's like, but the reality is it's a valuated index. So it's like, okay. So the companies that are bigger happen to be higher growth and higher multiples. So that's kind of skewing everything. So what you'd actually have to do is remove those from the actual index to get a true proxy. But I mean, if you look, like the influence of tech has really been, I would say kind of like the mid 90s to today. So you're looking at like a very, very different market. I would say, like, obviously, the tech bubble, right? It was like 40 something. But I just personally don't see that the market is like insanely overvalued. I know people are always trying to go from that perspective, but this is why you try to have a portfolio that will insulate you from any market shocks. This is why I always say buy at a discount, buy at a 20% discount. If all your stocks go down 20%, but you own them at a 20% discount, you're going to be way better off. But those type of black swans, there's no real way to account for them. And it's kind of a fool's errand where people will try to time the market and they'll go short the market. Like, no joke, I had a buddy, if you look back 2014, all right, I'm not even joking, this is dead serious. So let's go 2014. And again, this is the PE of the market. This is not the performance of the market. So he went like all cash. All right. He was like, market's overvalued. This is ridiculous. Da da da. And you're like, okay. And I don't know like when, if he got back in, but he missed out on like a doubling of the market if he didn't get back in. So that's where you have to be a little bit careful. I remember a few years ago, I have someone who's a very, very close friend who is very high up in GSAM, Goldman Sachs Asset Management. And their whole thesis, they always do these thematic things, and it's all free. You could go check it out. And they said, the market's done very well. We project that the next decade, the market return is going to be 6% for the S&P 500. It's like, okay, well, that was wrong. So I think trying to like project out like that is very difficult. That's why you have to own good companies at great prices, invest in the market, dollar cost average. But I'm not bearish on the market. I really am not. I think we need to see more returns from AI. I think that's something that people are like, let's see. But if you look back at the video that I did on Alphabet, they were one of like the first Mag 7 companies that actually showed a demonstrable impact from their AI investment. Like more searches, better searches, more ad revenue. So when you look at stuff like that, I think that's kind of where people need to see the other side of it. So Microsoft or Meta, it's like, are you getting this return on, all the money that you're investing in AI? And for companies that are heavily advertising focused, they actually are seeing a benefit. I mean, and you've probably experienced it firsthand. You're like, it's freaky, but like you'll be talking to somebody about watches, all right, and maybe even right now, I talk about watches, and like tomorrow I'll be like going through my email and like a watch advertisement will pop up, or the next time I open something on social, a watch thing will pop up. That's the type of stuff that is freaky, but from an advertising perspective, when someone's like, I wish I knew how to invest in stocks, and it's like Ken's super stock investing program comes up, you're like, oh my gosh, this is perfect. I mean, to have that ability is just like pretty crazy. Um, so Fantasticos. Uh, so we have SOFI, amazing growth. Yes. SOFI has, so the fascinating thing with SOFI is they're focused on one hyper specific demographic, which is Gen Z. And ultimately, when you think about it, there's no difference. All right. Don't get offended. Don't throw tomatoes. Don't be like that Tesla dude who's like, oh, I'm unsubscribing. It's like SOFI is no different from Ally. Ally's just focused on like everybody. SOFI is focused on a younger demographic, an underbanked demographic. So what they're trying to do is catch people when they're in their 20s. So they're going to be the bank of choice moving forward. But they also offer trading and all that stuff. By the way, Ally offers all the same stuff. They're just not, focusing on a younger demographic. But SOFI's growth is fantastic. The one thing you have to be very careful with SOFI is they're issuing a ton of shares. And if you look back at my SOFI videos, I mentioned this. So if you took SOFI when they IPO'd, I think they had like 65 million shares. Today they've got like 1.2 billion shares. If they just kept their shares exactly the same, the stock would be like $240 a share. Now, the average person's like, what? Because if you keep the share count the same, you have all this bigger value over the same, i.e. less shares. Now, if people actually knew that, they'd be going nuts. They wouldn't be throwing tomatoes at me when I do a video on Tesla. They'd be throwing it at Anthony Noto. But they're issuing a ton of shares. I mean, their stock-based compensation is insane, and that's something that Warren Buffett hates. And the funny thing is, the average person's like, I bought it at 10 and now it's 25. And it's like, yeah, dude, what if it was 240? Yeah. So that's the one thing you have to be careful of with these early stage growth companies when they do a lot of financing of their business and incentivizing of employees with stock. We all lose out as a result. But yes, it is growing tremendously. I'd like to see them use less equity to fund their business. What are your thoughts on bonds? I think they're really interesting, but nobody really talks about them. So bonds are definitely a good complement to a portfolio. I would say for all of us, I'm kind of taking it that we're all relatively young. Right now, when you think about bonds, if rates go down, the price of a bond increases. So very simply, let's just take 5%. Okay, 5%. So if you have a bond that's trading at 5% and the market's at 5%, it's going to trade for 100 cents on the dollar to be par value. If the market goes down to 3%, now this bond is worth a lot more. It's going to trade at a premium so that ultimately the market will level set. This would actually be a good thing for me to do in Microsoft Excel real time. So let me do this. These are the types of things you should be doing, Ken. Teaching people. Yeah, it's a good idea. All right, so let's take this example here. Okay, so we have N, which is the number of periods, IPY, PV, PMT, and FV. All right, so let's say it's a 10-year bond. All right, so it's a 10-year bond. We'll assume semi-annual coupon payments, which is pretty typical. All right, so here's the assumptions. Coupon, 5%. Time, 10 years. And the payment scheme is semi-annual. All right. So that means there's 20 periods and the payment will be $250. The future value will be 0. If the current market rate is also 5%, so 2.5%, the PV, we'll do the rate, we do the number of periods, we do the payment, we do the FA 3897. Nope, that doesn't make sense. Oh, 250. Hold on, wait for it. Here, let me make it simpler because it's getting, let's just say 10 years, let's say 5% PMT minus 5 FE 0. Okay, so if we take this and then we say the market goes to 3%, what is the PV? So we got the rate, we've got the number of periods, we got the PMT, we got the FV. All right, 42.65. That goes down pretty significantly because it's only 10 years. But if the market rate's at 5%, what is going on here? There we go. Okay. So, all right. So let's say the market goes to 3% instead of 5%. Okay. So basically, this is a 5% coupon. This isn't semi-annual, it's annual. Okay. So we'll do a couple scenarios here so you can see the difference. So this is what's called a par value bond. Okay. So if you look right here, if I move the rate down to 3%, meaning the market's now at 3%, this bond is worth more. It's 117. If the market goes to 7%, this bond is now 85.95. So I'll just remove this here. So this is what's called a par value bond. Here, I'll just move all this up here. Meow, meow, meow. So this is bond math. It's basically time value of money. So the same way that you would do a DCF, you could do bond calculations. It's the same, like literally the same logic. You would take these payments and you would do each one per year for 10 years. And you'd get the PV of 100 if you discounted at 5%. So the market goes down to 3%, this bond is worth more because it's paying 5 when the market's at 3. So it trades at a premium. Alternatively, if the market goes up, rates go up, and it's a 5% coupon bond, the bond decreases in value. So right now, with the Fed lowering rates, what that's going to do is that's going to increase the value of the bond. Now, if the Fed moves rates, you know, a quarter point, you know, 4.75%. Let me just fix this. The bond's going to go up $1.95. All right. So will it increase in value? Yes. I mean, if you bought a bond today and in a month, rates go down by a quarter point and you're making $1.95 on a $100 investment, you'd multiply that by 12. So 12 times 1.95, 2340. That's a nice return on a $100 investment. That's the annualized return. But that's really what's going on with bonds. So that's kind of how you would look at it. So I know that's, you guys are like, what? But I'm trying to answer Giovanni's question on bond investing or just fixed income in general. It's a good hedge for a portfolio. In general, though, I would say if you're younger, which I'm assuming the vast majority of you are, I wouldn't really like lean heavily towards bonds or fixed income in general. You know, I have a preferred investment in real estate, and it pays like a 10-11% coupon. There's also one BXSL. So that is senior secured. I'll pull it up. Hang on. So I'll pull it up on Yahoo Finance. This is a Blackstone fund. It's Blackstone, I think it's senior secured BXSL. Yeah, so Blackstone Secured Lending Fund. Here we go. So let's go check this out. Just bear with me. I'll get to the chat. I'm just on this like mental thought. I got to finish it here. So BXSL, if you look right here, Blackstone Secured Lending Fund, the yield, where's the yield? I don't know why they don't show the yield here. That's annoying. I mean, we could do the math pretty simply. Okay. So you got the, oh, here it is. Forward dividend and yield, 10.27%. All right. Now, the one thing that you do have to look at is what's it been doing over the last year. This is 1 day. It's kind of flat. It's kind of flat over the last year. Oh, it says 0.2%. But you're getting that coupon there of, 308 at 10.27% yield. So this is something that you could invest in from a fixed income perspective. The one thing that you have to be careful of is a lot of this stuff from a taxation perspective. You do have to be very careful because it'll be taxed as income. Also, different types of funds. So there's like closed-end funds, and there's different structures that the taxation is not advantageous. So you'd pretty much have to have it in a tax-advantaged account. But in general, because you're not going to get that upside, I just wouldn't be a fan. I'd rather invest in VOO, the S&P 500 and dollar cost average. Oh, okay. So we got someone here who's like, hey, I'm not a young kid. All right. So hold on. Let me, this is where the scroll bar is going to be the bane of my existence. I had this happen last week. The scroll bar here is just like, it's so hard to mess with. Oh, here we go. Hello. Okay, so hold on. I'm 48 with 3K in my portfolio. I've been doing options and buying stocks, but not going anywhere. How would you grow this account for someone my age? So the first question would be if it's in a tax advantaged account or not, meaning is it in like an IRA or Roth IRA versus a brokerage? You do have to be careful with like the tax impact. So I try to do all of my investing in tax advantaged accounts, so I'm not getting whacked on taxes. That's where you're going to get hammered with things like options. Options in general, you do have to be very, very careful. Options have leverage in them. So it's a double-edged sword. So it works really well when things are going up, but when it goes down, it's a nightmare. So I would definitely recommend maxing out a Roth IRA. So that's going to be $7,000 and VOO. I know that's not sexy, but that's what you want to have for a base. Once you have your kind of like base foundation in the market, so just to give you some perspective, S&P 500 over the last 70 years, 10.4% total return. So price and dividends, pretty good. That means rule of 72, 72 divided by your return, that's how long it takes to double. So you're basically going to be doubling every 10 years. Actually better than that, 7 years. So that's kind of how you want to think about it. Max out the IRA, 7,000. When you have a Roth IRA, when you take it out, it's tax-free. So you have tax-free compounding that's going on. That's where I would have VOO. Just dump it all in VOO. Now you're like, but you do all these videos on stocks and stuff like that. It's like, that's just me like freestyling and showing you guys like Wall Street. But if you said, Ken, what's your advice? Me, like hedge fund managers who are my friends who run multi-billion-dollar funds, like anybody comes up to us and they're like, what should I do? You got a hot stock? It's like VOO. VOO is the Vanguard S&P 500 total return. It's an ETF. It's a 0.03 expense ratio. It's the cheapest that you're going to get. That's what you should do. Period, full stop, end of story. Dollar cost average into it. So basically every 2 weeks, throw money in it. That's the right way to go. Once you've maxed that out and you're like, I'm comfortable with that, I got that rocking, that's when you should talk about like, okay, now I'll invest in individual stocks, options, what have you. But the other thing that nobody talks about, which is baffling to me, if you have a 401k, via your employer. The only 100% guaranteed rate of return you're ever going to get in your entire life is the employer match on a 401k. Okay, employer match. So if the employer's like, I'll match 6%. All right. So simple math. Let's say you make $100,000. That means you put in 6,000, they will match 6,000. And that doesn't go towards your limit. That is how you should be approaching things. And again, this is not financial advice. You should get a financial advisor, blah, blah, blah. I don't know your financial situation, all that crap. But, if it were me, that's how I would approach it. Like, full disclosure, like my Roth IRA and my 401k max out VOO. I'm not joking. Dead serious. Okay. Me, the guy, the stock guy. Okay. Now, beyond that, that's where I invest in individual stocks. So I have what's called a SEP IRA. It's a self-employed IRA. That's what it stands for. So you could do 25% of your gross, or I think 70,000, whichever's lower. That's what you throw into individual stocks, options, and all of that stuff. But there's just too much risk with options and individual stocks, frankly, that it's not going to be the right approach. That would be my 2 cents there, without knowing more about your financial situation. I know you want to hear like sexier stuff, but options trading is very, very difficult. Very, very difficult. Like, that's for like professionals. Okay, so I completely agree here. Distressed debt is interesting to look at, but I'd say average retail investors should stay away. I also agree. So leave that to the professionals. I'm not being like a jerk. They have a massive information advantage over you, and you will get destroyed. That's why, like, I always hate when you see whether it's YouTube or the internet, and someone's like, I have a trading strategy. It's like, okay, and red means sell and green means buy. It's like, what are you doing during the day? Working. When are you trading? Like, this to me, like, I'm like, huh? And people are selling these things for like tens of thousands of dollars. I'm just like, oh my gosh, it's like criminal. But yeah, dude, I would say dollar cost average VOO. It's not sexy, but you'll be very happy. And if you want to see the math, let's do the math. All right. So I'm going to help out my friend here, folks. So just bear with me a moment, but it'll be helpful for all of us. I literally do this. Like, all the people that I train, I always say, like, max out your retirement. I like say it over and over again. But let's take my friend here, 48. I'll do the actual math for you, my friend. All right. So 48. So today, let's go 65. All right. Retire 65. Okay. So that's going to be 17. But you actually have to add a year to that. This is where people mess up. So technically, and let me zoom in a little bit. Alt WQ. Alt WQ. 130. There we go. All right. So you actually have to add a year. I know this sounds like weird, but you have to include like your current year. Okay. So it's actually 18 full years. So you're talking about starting at 48 and going all the way through 65. So just follow the logic here. So if you invest every 2 weeks, the number of periods is actually 17 times 26. So that's the number of periods. And then if you take the 10.4% return on the S&P 500 and divide that by 26, okay, that's going to be the periodic return. Just follow the logic here, please. So if you're going to do a Roth IRA investment, and I don't know what you're starting with, I'll just say you're starting with 0. All right. So let's do 7,000 that you're investing. So $269 every 2 weeks for the next 18 years. All right. So it's actually 18 years. Let's see what the future value is. Drum roll, please. All right. This is literally just VOO. Okay. So you got the periodic rate, you got the number of periods, you got the PMT, you got the PV. Bam. 368,000 large. All right. And that's just if you're doing 7,000 per year. So this is 7,000 per year. Okay. That's what you end up with. 368,648. Now, if you could also have employer 401k, this is where it gets really fun. Again, same thing, S&P 500, 10.4% return. All right. So now you're talking about $23,500. Okay. So the limit for a 401k in 2025 is 23,500. But if your employer also puts money in, you could get higher. But let's say you're just doing 23,500. All right. Let's check that one out. Oh, buddy. All right. Now you're talking about real money. All right. 1.6 million. That's what I'm talking about. And this is just like simple, like math, present value, future value. Okay. But that would be my 2 cents here. Like go for the S&P 500. So this is VOO. This is S&P 500 total return. Okay. You dollar cost average into that thing. If you're just doing the IRA, $269 every 2 weeks, bam. You just do it religiously. VOO, VOO, VOO. Don't even think about it. 368, 648, let's call it 650. And then if you also throw the 401k in there, bam, 1.6 million. That's real money. That's real money. All right. Let's see the other part of the chat. Okay, here we go. Whoop. I hope you've been doing well. I have, Theo. Good to hear from you, bro. Curious to hear your thoughts on MIT study on AI projects failing and how that affects Meta's push into superintelligence segment. So hold that thought because I want to pull up. I sent this article to a friend and I want to show it to you guys. I have like coaches. I know it might seem corny, but to do YouTube and all the crap that I'm trying to do online. So one of my coaches, he's a big AI guy. I want to see, I should be able to pull up this article. It was an article that was in Fortune. And it was about AI backlash. So let's see. It's almost tragic. AI backlash Fortune article. That should be enough to pull it up. Hey. All right. So check this out, everybody. And this is basically addressing your question there, Theo. All right. Come on. Sharing is caring. Here we go. All right. No notifications. Sorry. Okay. It's almost tragic. Bubble or not, the AI backlash is validating what one researcher and critic has been saying for years. So this dude, Gary Marcus, okay, NYU professor emeritus, his whole entire career has been built on machine learning. That's it. This is all the guy has done for the last over 2 decades. And he was saying, like, back in 2016, 10 years ago even, like, AI is not going to replace humans, all this stuff. All right. Now, I'm not going to go through the whole thing, but I think I should be able to put this in the chat. I don't know how this all works. Like, if you guys could see what I put in the chat. Let's see. Send. There you go. So I just popped into the chat the link to this article, but I'll just kind of like do like a little flyover here. So GPT-5, OpenAI totally screwed up. Good job, Sam Altman. 95% of generative AI pilots at companies are failing. Oh no. So tech sell-off ensued, blibbity blobbity. But this is the guy, Gary Marcus, warning of the limits of large language models since 2019 and warning of a potential bubble and problematic economics since 2023. All right. This is all this dude has done. Okay. All his entire career. And what he's basically saying is that you cannot replace human beings. I know they're talking about like, artificial general intelligence and all this other crap. But, and again, I'm not going to go through the whole thing, but I would definitely recommend checking that out. And then let me go back and we'll actually have a conversation here. So the punchline is this. A lot of people don't understand AI. So these are LLMs, large language models. They are horrible at math. Horrible. So the way that AI works is it like scrapes and processes all of this data, all of this information. The thing that you don't realize is you need to attach Python to it to do basic math. Like it can read 2 + 2 and say 2 + 2 = 4, but it's not able to do the computation. Like you have to add something to it. Now, what's interesting is we as human beings, and that whole article gets into that, we as human beings, we're not just reading, just doing math. Like we're able to, like, this is the way our brains were created, where like we can go between, where we can like read something, do math, think spatially. Like it's not like that. It's very linear. So that's the one thing that I would caveat and be careful with. So AI projects failing, super intelligence, all of this stuff. So here's where I think AI, this is where things kind of break down. So just hear me out for a second. There are certain things in life where you cannot replace a human element. So for example, like let's say you broke up, right? And you're heartbroken. You're like, oh man, like I thought they were the one. Imagine like talking to a bot and it's like, hey, Barbie broke up with me. We were going to be Ken and Barbie. Wah. So what the AI is going to do is say, hey, I know exactly how you feel. And it's going to like go through like, stories of heartbreak. You're probably feeling this, but this is what you need to understand and all of this stuff. Now, you as a human being, me as a human being, like maybe you read that and you find some level of comfort. But what I actually would like is I want to talk to a human being, okay, who said, hey, dude, I got my heart broken. This is what it's going to be like. Like it's going to suck for this long, and then you'll get back on your horse after this time and stuff like that. Similarly, robo investing, friends, robo investing has existed for well over a decade. Why aren't people just using robots to invest? Now, I know you could say like, hey, Renaissance technologies, algorithmic trading, like again, totally different. Like, let's just put that on the shelf for a second. And by the way, huge fan, James Simons, the whole 9 yards, the GOAT. But when you talk about, like, I have friends that are like, I created an AI trading bot. It's like, really? And they've back tested. But the problem is back testing. So we're talking about ex ante versus ex post. All right. It works really great going backwards with data that's already been produced, but it doesn't actually work going forwards. That's the problem. Okay. So when you already have data, like if I told you last year, like what's going to happen, and I don't know how many people this is relevant to, but like the National Football League, I got my fantasy football draft on Thursday. So AI would look at who did well last year, okay, and it would draft the team that would win the championship last year. The team that would win the championship last year is not the team that's going to win the championship this year. Hopefully that analogy makes sense. So that's one of the challenges with AI. It's LLM, large language model, all right? So it's very good for a lot of tasks, but it's very bad for other certain tasks. Like math, it sucks at. It's absolutely horrible. So one of the challenges, like with super intelligence, which is what we are, not just me, you, okay? We could do math. We can have conversations. We have feelings. We have thoughts. We have insights. Like that's where it kind of all breaks down. And again, read that article that I put in the chat here. And the guy, Gary Marcus, it's a fascinating article. But basically what it talks about is the human element for now is kind of irreplaceable because that feeling piece, like you could program something to feel certain things, but it's very different from the actual feeling. Like it's been proven people can die of heartbreak. All right. So like, let's say you're married and your spouse dies, like your body will produce inflammatory markers and cytokines. Like you could literally have a heart attack or a stroke. Your chances of it are way higher afterwards. Like a robot, like if the programmer of the robot dies, the robot doesn't care. It has no freaking feelings. Like, what are we talking about here? Now you could program it like, I'm sad. But again, that's very different from the actual feeling. Think about it like this. When you walk into a room and you meet someone for the first time, instantaneously you have like an actual physical feeling. They're for real, they're not for real, they're fake. Like all these things just go flooding through your head. And again, it's like how we've evolved over time as human beings, right? Fight or flight. Like you're going through all of that before the person even speaks. So that's something AI cannot replicate. So the meta super intelligence piece, the thing that we all have to understand is like meta, the metaverse, all of this stuff, it is a small component of the overall business. Like the metaverse is like a freaking money losing piece of garbage. But the issue is 97% of their business is advertising. So they can throw billions of dollars into the metaverse and kind of like wait until it catches fire. I'm definitely not of the mindset like when you hear all these people, and now again, what we're getting, like ChatGPT 5, it's definitely way different than what they're seeing on their end. We're only getting, like a small glimpse into what they actually see. So when people are like, oh, artificial general intelligence is going to happen by December, like, um, I think it's going to be a little bit clunkier than that. It's able to process a lot of data and information. It sucks with math, and like there's no replacing the human element with feeling. Um, so let me just share these, and we could keep riffing on that. I know it's a popular topic. My preference is a total world market cap weighted index instead of US only, but to each their own. Yeah, that's totally cool. So there's instead of VOO, I think it's VTO. It's like the Vanguard Total Stock Index, I think it is. VTO. No. Vanguard World. No. I'm just trying to find the stupid ticker. VT. VT is the Vanguard Total World Stock Index Fund. So if you want to invest in just like equities worldwide, that's the way that you could do it. Yeah, nuclear arms race of spending on AI among the big tech companies gives me pause. The thing is, they got the money for it, so let them go nuts. But yeah, it is definitely an arms race, and that is something that we have to be mindful of. Where's the innovation going to come from? So when you look at like Google, right? Larry Page, Sergey Brin, search engine stuff, and you look at search engines back in the day, they were freaking horrific. I mean, they were horrific. So they could, as two programmers, create something better. Okay. With AI, and there's a lot of innovation going on with AI, 100% totally agree. But I think the thing that we need to kind of be mindful of, I don't see like you and I getting together and we're going to like be the next Meta. Like it's just like they're the ones that are innovating. It's like who's going to be the biggest proliferator of green energy? ExxonMobil. And you're like, "Oh, they're oil and gas, they're destroying the environment." It's like, hold the phone. They've got like 60,000 engineers, the smartest engineers in the entire world. They're going to figure out green energy faster than we are, like, growing, mold and algae in like an above ground pool in the backyard. I'm sorry. So where I get more concerned is like a company's coming out and it's like AI. It's like, okay, I could see like leveraging existing tools and stuff like that, but the innovation is going to come from the Microsofts, the Amazons. I mean, they're pouring billions and billions into it, but I mean, you're talking about like companies that literally have tens of billions of dollars of cash. Literally. I mean, it's unfathomable. The only investment that we have to offer is time, and that's fine. But, they have time and money and brain power. Hey, Alex, what's up, man? So that's the thing that I would mention. So, David, do they actually have a plan for monetizing it? The metaverse? Yes. Mark Zuckerberg said on the last earnings call that they're actually seeing a lot of growth in the RIVN sunglasses that they have been selling. And, that is, it's hard to describe, but like you could actually see stuff like on the lens in your eye. I know it sounds like super weird, but you could like talk and it'll search stuff, which I know sounds like super freaky. That's how they're currently monetizing it. But you also have like the headset. I think this is something I do think, 5 to 10 years from now. So let's take this live stream. Okay. I definitely 1000% think in the not too distant future, we will be able to like wear a headset from Meta. And instead of me being like here virtually, like we'll be in a room like together. And like I could be standing up and talking and stuff like that. And you could all like literally be like sitting in the room. Now it'll all be virtual, and I've seen demos of this, but we're definitely not around the corner, but that's how they're going to monetize it. So they're actually going to eat into the business of like a Zoom. And if you think about it, right, if you don't have to travel for a meeting and you could have the same experience as though you're physically there, that is where there's going to be tremendous value. So you could see like a platform like Zoom just getting decimated when people are like, yeah, we're just using our headsets, we're meeting, and everybody's in different areas of the world, but you could literally feel as though you're physically in the same room. That is kind of the monetization scenario. Also, you think about things like video games and stuff like that. That's where it gets like crazy. But that's how they plan on monetizing it. But yeah, it's still years away, and they're losing billions of dollars on the metaverse. It's actually a really cool combo. So one concern is that these companies may be overstating the useful life of these AI data centers. Totally agree. And infrastructure. Again, I'm not an expert on AI, but something to consider. So this has been, kind of my take as well. This like whole arms race. You look at all the Mag 7, their capex spend for 26 and 27 is like massive. But then it levels off 28, 29, and 30. Okay. So it's like, what's going on there? At that point, it goes from growth capex to maintenance capex. They have to maintain these data centers. But, they said, what was that? Meta? I think they're building out a data center, or either Meta or Microsoft. They're building out a data center that's going to be half the size of Manhattan. I mean, I honestly don't know the answer. Like, we're kind of spitballing here, but like, how much more capacity do you need when you have something that's that large? I don't know. I don't know the answer, but I think there's going to be new uses for the technology once it's available. It's kind of like AWS in the cloud. Why is it growing so much? Because more and more people are using it. And that goes back, I know like people are going to lose their minds, like the guy that, left the channel, but like Tesla, humanoid robots. Okay. So humanoid robots, if you could imagine a scenario where everybody has a humanoid robot in their house, and they're doing the dishes, the laundry, vacuuming, and stuff like that. That's not inconceivable. I really don't think that's like a crazy concept at all whatsoever. That market potential is insane. Like everybody in their house has a humanoid robot. That to me is like, whoa. That's a $7 trillion market potential. Or full self-driving cars. That's a $13 trillion market potential. Now it's like, well, where'd they come up with those numbers? Like, I didn't come up with the numbers, but that's what they're saying by 2050, TAM, total addressable market. But you think about it, there's so many things like a cell phone, right? Everybody has a cell phone. It's like we can't imagine life without it, right? But if I were to talk about the cell phone in like 1995, 30 years ago, you'd be like, why don't you just go use a payphone if you want to talk to somebody? And it's like, no, it's more than that. Like you could text, you could see the people. It's a computer in your hand. People would be like, what? It's the same thing. Like when we have full self-driving cars, humanoid robots. See, this is my contention with full self-driving cars. I know like people are going nuts on Uber and like Bill Ackman and stuff like that. But I kind of look at it, it's like, if I have a full self-driving car, why am I taking an Uber or a Lyft? I don't know the use case at that point. Like, I'm just getting in my car, I'm reading the paper or a book, and I just get to my destination. Like, why would people need public transit? Now you could talk about parking and stuff like that, but these are like the interesting conversations where I say, think about the future and what's going to be needed. So like when we were talking earlier about like GE Vernova, yeah, you're going to need the infrastructure to support all of this. That's the logic for Sterling Infrastructure, STRL, GE Vernova, GEV, a lot of these like data center, electricity, infrastructure type plays. But again, it's like, it's so amorphous right now because it's so hard to quantify. So yeah, large opportunity cost, the cost and staff required to maintain, build these AI resources may not pay off. I suppose time will tell. But now they're saying, like Silicon Valley, like I'm always following this stuff because it's really interesting. Now what they're saying is they don't need junior programmers. You might have seen this in the news, but like computer science majors are having a really difficult time getting employed because now someone's saying, you know what? I can get 5 AI bots to program, like Bolt. I don't know if you guys are familiar with Bolt. Like you literally just type, this is what I want, and it'll create the program for you. It's freaking amazing. It's unbelievable. So now instead of them overseeing these like junior programmers, they're just checking what the AI did. Like that's crazy. And that's like an actual real use case. Um, so hold on. Uh, Three statement on BBWI. It seems cheap with low growth rate assumptions. The idea is they will grow their international branding through franchising. So there's certain industries that are like currently going through like a pretty significant disruption. So you got Bath and Body Works. My bigger concern is the real estate. That's what did in Bed Bath and Beyond. These businesses that have like the heavy need on real estate spend, that's the real challenge. So if they were like fully online, that's where it becomes an interesting scenario. But there's a lot of cases like that. Just be aware of like value traps. I would really look at the real estate side of things. So that's Bath and Body Works, guys, BBWI. Hope these CEOs don't look back in 10 years and say, gee, why did we waste all those hundreds of billions of dollars on these empty data centers? I don't think they're going to be empty. I think it's more of a question of return on investment. I don't think they're going to see it very soon. Again, I did say that it was demonstrated. Google, out of all of them, Google has actually seen increased advertising spend because they're able to offer more efficient results. So, you're getting more bang for your buck because they're using AI. That is like a real demonstrable use case. But I think the companies that are building out all the data centers for the capacity and stuff like that, I think that's a much, much longer time frame. Jason, I enjoyed your video on Rivian. Looking forward to R2 next year. Thanks, man. Yeah, that's my whole thing with Rivian. They just have like this massive, massive runway. They have 6.6 years, literally years of cash. And they also have long-term investors with Volkswagen and Amazon. So when people are like, oh, it's garbage, Lucid's garbage, it's like, yeah, Lucid is garbage. I don't think Rivian is a comparable example. Like Rivian's a particular niche. And again, you don't even have to be like, all into EV. It's like a hyper niche. You're talking about people that like camping and off-roading. And 98% of people that buy a Rivian say that they'd buy it again. There's no car on the planet, not Ferrari, not Lamborghini. There's no car on the planet where 98% of people that have bought it said they'd buy another one again. None. You got to remember, RJ Scaringe, the CEO, he's got a PhD. Now, that's not the be all end all. He spent 10 years designing the R1 before it even came to market. Designing. So like everything that you could possibly imagine and think of, like he's imagined and thought of, and that's what you see in front of you. And the fact that they're now, gross profit positive, it's huge. But again, until the R2 comes out, it's going to pretty much move sideways. That's one of those things. So if you have a long-term perspective, that could be an opportunity. Definitely in the, I would say pretty much until the R2 comes out. So the next 6 months and change, I don't see Rivian like skyrocketing or anything. I think there's going to be plenty of buying opportunities. I don't think self-driving cars are a death blow for Uber. Okay. Uber could serve as a demand aggregator for ride hailing in a self-driving car. That's true. I always forget the frickin', you guys all know. There's a company where you could like rent your car to people. There's a Toro, something like that. That's kind of like the use case where you could say like self-driving car. If you have a self-driving car and you offer it to people, like that could be a pretty lucrative opportunity. But to your point, I agree. Like the aggregation of it, it's like, okay, I need to go somewhere. Now what do I do? So yeah, that would be the play. Like if you're traveling, having a self-driving car at home doesn't really do much for you. So I do agree with that. And even right now, with Tesla and the robo taxi and Waymo, like they're using Uber and Lyft because the last thing anybody needs is a new frickin' app that they need to download. So yeah, I hear what you're saying there for sure. David, I still believe the AI revolution has been much underrated. Um, it's funny because there's some people that use it all the time. Like I say I use ChatGPT pretty often, but I also find that people put too much credence into AI. And there's a lot of time, like one of my buddies who's like really into AI. The old joke is I used to work on something for 8 hours and spend 1 hour checking it. And it's now with AI, I spend 1 hour working on something and 8 hours checking it. So it's it's kind of one of those ironic things. It's definitely going to get better over time, but no joke. I have the paid version of ChatGPT. I said, "Give me the best performing stock of the S&P 500 every year since 2000." Simple prompt, okay? Very specific. And it said I could not find a website with that. What do you mean you need a website for that? Like, aren't you like God in the computer? Aren't you able to find this? So like I had to like find websites. I was like, find the websites that have the performance. And then I got like all this conflicting information. So I was like, this is just insane. Like I could have probably found it faster myself. It was the most frustrating exercise in the world. I could just do, like AI horror stories with simple prompts. And I know like garbage in, garbage out. I get that, but I said like S&P 500, that's an index, companies, like all that stuff. And it was like, sorry, I can't find it. And it gave me like the last 3 years. I was like, that's not what I asked for. But that's the type of stuff. Yeah, David, you're really banking on the deep dive into Howard Hughes and Berkshire. It's funny that you say that because Howard Hughes did pop. Let me see. It went above 70. Yeah, 75.10. Maybe it was me talking about it. Maybe you all went into Howard Hughes. I would actually have to do both of those justice. I'm gonna have to like actually do a breakdown first. Doing it on the fly, it just would be a little clunky. But the way that you would approach it is you look at all Berkshire's investments and you would basically want to figure out what's the fair market value of each of those investments and the associated stakes. And then you would basically back into the total value from there and then just add in the cash. So with something like Cap IQ, it's not that hard because you just take the median for everything. And then you'd say, okay, this is what all of those stakes are worth. If you just say the median of what Wall Street thinks, that would be one way of doing it. Howard Hughes is a different one. That's more option value. So the thing with Howard Hughes is Bill Ackman invested at, I believe it was $100 a share. He bought $900 million worth of the stock at a value of $100 a share when the stock was at 65. So now you think to yourself, like, wait a sec. Now he's a die-in-the-wool Warren Buffett disciple. So you buy a dollar for 50 cents. So if you're paying 100 for something and you think it's 50% undervalued at $100, that means that your value, i.e. Bill Ackman, is 150 when it's at 65. So now you think to yourself, wait a second, if that's the case, then you're buying it at 65 or even 75. If you're buying it at 75, you're getting 100% rate of return. That would be kind of like the simple math and logic. The issue is, if you look at it right now and you do a DCF, you're not going to get a proper valuation because he's trying to create a holding company structure like Berkshire Hathaway. It's not an insurance company. He said he wants to buy an insurance company, so wait for it. But when Berkshire Hathaway was first purchased by Warren Buffett, it was a textile company. And then he converted it later on. It's a famous story. He lost a ton of money on it. It ended up being a horrible business because he bought it, typical value investor. It was like a net asset type play. But if you actually look at it, and there's a really good presentation. Someone mentioned it last time. If you just type Bill Ackman presentation, Pershing Square, Howard Hughes, okay? He had one of his fund managers do a whole presentation. I mean, the thing is like over an hour long. It's phenomenal. And he goes through like what their approach is. So if you look at the actual numbers historically, like what we do on the channel, DCF, all that stuff, you're not going to get the appropriate value. If you look at Cap IQ, it's not looking at it based on what his vision is. It's looking at it based on what it actually has done. And it's a real estate development company. You're not buying it as a real estate development company. You're buying it to be the next Berkshire. I have a full 10% position in it because I believe in Bill Ackman. But again, this is one of those things, if I do on the YouTube channel, nobody will watch it because nobody's searching for it. But one day, with all of your help, and I have 100,000 subscribers someday, then I'll be able to do it on like HHH, and even Berkshire has like a really crappy search optimization on it. It like nobody's searching for it to invest. But yeah, I will totally. I'll definitely do a deep dive at some point on it. I think Apple's the weakest AI player among the Mag 7. I don't understand why they trade at such a premium. And let me capture the next point. And on top of that, they're buying back shares, overpaying for them, plus no new innovation. I don't disagree, my friend. Like, if you saw the video I did on Apple, not really impressed. I don't own Apple anymore. And I know it's like, oh, how could you say that? Oh, I would want to buy it definitely below 200. I think people are kind of betting like Apple always ends up on top. And what they've said to the market is, you know, we don't always start first, but we finish first. All right, that's cool. I'll just like wait until you keep investing more money and the stock pulls back. But yeah, I don't see it yet either. And that's what people are really waiting for. I honestly don't know why it popped. Like when I did the video, it was like 209 or 210. And now it's like 225, 230. No idea. I think it just captures a premium because it's Apple. But, you know, right now it's all about like the next iPhone. But the future, it's like, what are you doing with AI? Some people, like Dan and I've said, buy Perplexity, you know, buy an AI company. I don't know like how great of a move that would be. They should be able to innovate internally, but they've really underwhelmed the market with what they're doing in AI. And people are like, guys, what is it that you're doing? What is your play with AI? And I don't think just making a better iPhone. Like if you think about it from an incremental perspective, the difference between the latest iPhone and the previous iPhone, like years ago, it was like, oh my gosh, difference. But the difference between like the 16 and the 17, the 17 and the 18 is so marginal. It's so marginal that you really can't say like, my gosh, this is incredible. But like previously when it was in like the single digits, like the iPhone 6 to 7, it was like, oh my gosh, leaps and bounds difference. But I don't think they're capturing that that much of a premium. To see products are not that mature right now. I feel like there will be a turning point in the future. Yeah, I'm also a heavy AI user. I totally agree. But someone has to like aggregate it. I think one of my buddies, he works in strategic finance at Amazon. He was talking about some of the stuff they use internally. I think one was called like windsurf. But basically, there are tools that leverage all of the different AIs out there. So imagine like you use a tool and it's going to leverage like Anthropic, ChatGPT, Bolt, you know, all these things. So there are things like that. That might be something that you'd be interested in. I'm almost positive he said windsurf and he said something else. It was like so over my head. The stuff he was talking about was just insane. That would be a good piece of advice. Like find a friend that's working for one of the Mag 7 companies and just be like, hey, what are you guys up to? And you'll just be sitting there with your jaw dropped. You'll be like, what? He told me, he's like, yeah, he said his group focuses on cost savings. So they've saved investors $1 billion per year just choosing to see what the optimal way to deliver stuff to you is. Like, is it better to use a drone, a person, the postal service? Like, crazy, $1 billion of savings. Now, take that $1 billion of savings and then put a multiple on it. That's the value. I mean, it's crazy. Ackman is confusing. He seems to go against his principles all the time. Yeah, that's kind of like the Uber one. That one is a little bit more of a head scratcher for me. He says he likes simple, predictable businesses, but then buys HHH, Brookfield, Valiant. Also bought high and sold low on Netflix, despite the underlying business being strong. Yeah, that one was weird, but dude, he's got 40% year-over-year returns for over a decade. So in spite of those, you know, bad investments. So HHH, like he's buying that as a holding company. That's not like, if you look at the numbers, it's like, there's no way it makes any like sense that you would pay $100 for something that's trading at 65. But when you consider he wants it to be the next the next Berkshire, that's the key. Like, I also hear what you're saying with like Herbalife, and that whole like time wasting exercise with Carl Icahn. So the way that it actually happened, because I remember I was working at the hedge fund at the time, and he had an investor conference, and he literally was announcing like his latest short, and he said, "Everybody in the audience, raise your hand if you use Herbalife products." Nobody raised their hand. Now let's step back for a second. Okay, let's step back for a second. He's talking to people that are like very wealthy, hedge fund managers. I don't anticipate that they're, part of like Herbalife MLM, world. So the fact that they didn't raise their hand shouldn't be a shocker to anybody. But like everybody like looked around, they're like, oh my gosh, nobody uses this. It's obviously a Ponzi scheme. So it was like the premise was didn't make sense on the face. And frickin' Carl Icahn, called him to the carpet, and Carl Icahn definitely ended up winning. So yeah, I hear you, dude. I'm not saying he's like God or anything like that. But when someone has billions of dollars and they're committed to creating the next Berkshire Hathaway, and they're doing it through an entity, and they're like identifying like, this is the entity that I'm doing it through. It's called HHH. And if you believe in my track record and my plan, like, then maybe you'll believe in this as an investment. So this is kind of like a long-term play. It's not like, oh my gosh, you're going to buy it today and tomorrow it's going to be worth, 100 or 150, like not the case. But if someone's willing to put an investment at $100 a share for something that is trading at 65, I'm listening. That to me is just like bonkers. Um, yeah. Yeah, I remember he drew the ire of Charlie Munger by comparing Valiant to Berkshire, rightfully so. Um, so yeah, I mean, there's a lot of different disciples of Warren Buffett and Charlie Munger. Um, not any of them have the same track record over the long term, but there's you look at Prem Watsa, who is based in Canada. He does the same kind of like Berkshire type setup. He's been pretty successful, but nobody's been able to duplicate their track record. And also part of that too is time frame, right? So when you're running a hedge fund, people don't care 5 years, 10 years. They care like month to month. So it's very difficult to have like a Buffett strategy in a hedge fund construct. It's very difficult unless you have a really strict long-term lockup. From your experience, what has been one thing many analysts seem to struggle to understand when you teach them? Good question. I would say valuation. That one's the toughest. And frankly, that was the toughest for me to get a grasp of. I think too many people try to apply just logic to valuation. And if you do that, like the ding dong that was on the channel, go look at the comments. If you guys want to laugh, go look at the comments on the Tesla video. And the dude, it was like one of the first comments who said he's leaving the channel. I touched on it earlier tonight when I started the live stream. And the guy was like, you're falsely using a DCF to give people hope. It's like, relax, bro. It reminded me of the scene in Willy Wonka when the grandfather and Charlie are leaving the chocolate factory, and it was because he stole the everlasting gobstopper and didn't give it back. And the grandfather goes nuts. He goes, "You're gonna take a boy's dreams and smash him to pieces." And Willy Wonka was like, "Dude, this kid's got the freaking everlasting gobstopper. He just puts it back like I'm giving you the keys to the castle." So he puts it back, and then it's like, "You did it, yay!" But like the grandfather going nuts was what this guy was like. It was just like total bizarro fest. So people don't understand valuation because what happens is they apply brute logic, brute force logic to it. And when you think about it, there's an art and a science to valuation and financial modeling. The mechanics are very scientific, logical. Okay. The art is, Does this multiple make sense? You know, like where you kind of tweak things, that is the art part of it. And anybody could do a DCF and be like, this is the number, this is the value. Okay. But if you have, you know, multiple cases, you know, when I bought Meta during Liberation Day and all that tariff craziness, Meta went below my bear case. Okay. My bear case was at 560 and Meta was like below 500. So I was like, whoa, wait a second. Like I ran the bear case at like super conservative assumptions. So it's below my bear case and significantly below my bear case. I was like, this is stupid. If I believe anything in what I tell everybody, it's like, I got to buy this freaking thing. And thank God I did. I bought it at like 480. No joke. And it wasn't that long ago, in April. So that's really the key is you want to be lower on revenues, higher on expenses. This stuff is pretty straightforward, but it takes time for it to click with people. And I think, yeah, dude, I gotta click on this. And this is like comment of the night. Tesla and Palantir investors are the most emotionally immature and volatile people. Dude, the understatement of the year. Okay. You could throw hymns in, by the way. I did a video on hymns and I'm like, yeah, it's overvalued. I wouldn't buy it at these levels. Go look back at the comments. It's like, what? I mean, it's like, you don't know what you're talking about. You don't understand. I'll kill yourself. And I'm just like, holy crap, geez, calm the frick down. Now, I would think if I thought Hims was like the best company, the best kept secret, I would feel bad for someone like me. It's like, look, this idiot, he's got a YouTube channel and he's not buying the best stock in the history of mankind. But here's the logic. There's like 10 other companies that do exactly what they do, like literally exactly what they do. There's no competitive advantage. And then people go, oh, no, you don't understand. It's like, tell me what I don't understand. Tell me, please. You know, so to your point with like Palantir, I honestly, I'm not doing a Palantir video for the foreseeable future for that exact reason. Like, people will like hunt me down and like slash my tires. I'm not dealing with it. Like, these people are bananas. And so it's the same thing with Tesla. Like, the positive and the negative is just like bizarre. Okay. So there's some people that are so positive, it's like they're not even in reality. And then there's some people that are so negative, it's like an existential crisis of humanity. And it's just like, it's numbers. I have no emotion. There's not one stock I've ever invested in where like I'm emotionally invested. Ever. It's numbers. I run the numbers. I buy at a discount. That's it. Period. But I mean, some people, it's like, oh my gosh. So with valuation, I was running a training program a few weeks ago. And, you know, I always, you know, I talk about the YouTube channel and stuff like that. I'm just curious, like, what are people invested in? They're like, what do you think about Palantir? And I was like, don't want to offend anybody. Think it's a little ahead of itself. It's a little overvalued. Now, once I said that, instant response. Well, what about this? What about that? And I'm like, what about what? Like, it's ahead of itself. It's probably like 2 years. The stock's 2 years ahead of where it should be. And they're like, but you don't understand the business. They're saving so much money and government and all this stuff. And they just like spitfire like all of this crap. And it's like, where's the value? It's like I did a video on Rocket Lab, another one I will never do a video on again. Dude, like the comments that I got were just so bananas. Like, oh, well, you don't understand. What don't I understand? The new rocket that's coming out. Okay, when's it coming out? 2028. All right, what's that going to do? The stock's going to go through the roof. I'm like, okay, like why? Like, just like explain, like what's it going to do? How much revenue is it going to generate? I mean, a lot. Okay, how much is a lot? 200 million? 500 million? Like, think about the absurdity of this, people. Who's in the market for launching satellites into space? Governments? Okay. SpaceX, right? You know, Amazon, they're doing the Kuiper, you know, where they're trying to create a network via satellites. Okay, got it. Maybe some governments. No human being outside of someone that has like untold amounts of money is launching satellites into the stratosphere. Like, there's a limited market to this. But oh my gosh, you go look at the Rocket Lab comments, it's like bizarro fest. Like total insanity. And it's just like, I can't deal with it. It's madness. That's why, like, I figured like we were on the other side of things with Tesla. Like I was like, okay, you know, it's been a little bit of time. And then I got Psycho Fest comment. And I'm just like, all right, dude, like, I don't know what to tell people. So like I actually don't like these controversial stocks where people get all like emotional about it. It's just like, oh my gosh. So this one's good. Buffett said, paraphrasing, he doesn't use DCF models. He said you don't need to know if someone's 290 or 300 pounds to know they're fat. Ha! Yeah. So truth be told, Buffett does do discounted cash flow valuations on every company, but he does like back of the envelope. Like I could literally show you right now, literally right now, I will, how Buffett does a valuation. Okay. And I'm going to find, so here's a book. All right. Write this down. The New Buffettology by Mary Buffett. Coincidence, eh? Mary Buffett is Warren Buffett's daughter-in-law. All right. So she had direct access to Warren Buffett. And she said, tell me how you invest. All right. I'm going to show it to you guys real time in Microsoft Excel. And you're going to be like, come on. No. Yeah. Wait for it. It's coming at you. Okay. So here's what Buffett does. All right. So I'll create a new tab. Let me make sure this is showing on the screen. Yeah. Okay. So Buffett investing. This is in the book. Okay. The New Buffettology by Mary Buffett. Okay. So effectively what you do is you look at the 10-year low P. All right. You look at the 10-year EPS CAGR, current dividend. Okay. All right. So I'm just going to spitball numbers and then you'll kind of see the logic here. All right. And you can find this data so quickly and easily. So let's say the company's 10-year low PE ratio is 5. Okay. And the 10-year EPS CAGR is 8%. All right. And the current dividend is $1. Okay. Wait till you see this. You're going to be like, what? And again, I'm totally spitballing here, but the logic applies. I have the model that I created off of this somewhere, but here's what happens. Okay. And then there's the current EPS. Okay. I'm not joking. This is like dead serious. I'm not joking. This is like actual literal. You'll find it in the frickin' book. Okay. So now you have, so year 0, which is today. All right, so check this out. YEAR space 0. Bam. Okay. So we go like this. 2, 3, 4, 5, 6, 7, 8, 9, 10. All right. So year 0, we've got EPS. So again, current EPS, $2. All right. And then he says 10-year EPS CAGR. Let's grow it at the 10-year EPS CAGR. So it goes this times 1 plus 8%. F4. Lock it. Bam. All right. Carry it, carry it, carry it. Okay. All right. So this is the PE ratio 10 years from now. Okay. Now, you have the dividend. All right. $1. You guys aren't even, you're going to be like, are you serious, Ken? I'm dead freaking serious. It's outlined in the whole book. All right. And he says, I'm not even going to grow that. All right. I'm not even going to grow that. Okay. So now he says the dividend, which I got over the last 10 years, is $10. I'm going to take this EPS, I'm going to multiply it by the 10-year low PE. Okay. Bam. So now the total right here, I'm going to do some math here to see. I'm going to try to get a number that you'll be impressed by. So let's see, 3159 is the value. So wait for it. Okay. Let's say price today is $15. The stock. All right. You're not even going to believe this. This is literally how the guy frickin' invests. I'm dead frickin' serious, okay? All right. So check this out. Price today, okay? So it goes like this. Price today, 15, all right? Annual return. I'm not joking. This is dead serious, dead serious. Go get the book, all right? So you do this, divided by this. It's to the 10th power, so 0.1 minus 1. Bam, okay? So check this out. I'm dead serious, dead serious. I know you don't believe me, all right? Annual return, 7.73%. And what he says is, you know what? Based on the rule of 72, if I can get something that's 7% or above, I'm interested. Okay? So we got rule of 72. So he says, okay, 0.72 divided by this. Bam, not name. There you go. So it's going to double in 9.3 years. Okay? His whole barometer is greater than 7%. I'm dead freaking serious. If the answer is yes, he moves forward. All right. The new Buffettology, that is literally what he does. Okay. So to your point, okay, does he do a DCF model? Like he'll actually do a paper DCF, just like Steve Schwartzman. Like they didn't have Microsoft Excel when they were like, you know, coming up. So no joke, these guys will just grab a piece of paper and do this. Okay, what's this? What's this? What's this? And again, you have to assume it's core EPS and all that crap. All right, let me zoom in a little bit so it's easier to see. All right. There you go. Greater than 7%? Yup. Invest. Dead serious. Dead serious. Okay. So that is what Warren Buffett does. If it's greater than 7%, rock and roll. Now, here's the funny thing, friends. If you look at the vast majority of companies, NVIDIA, Palantir, throw in like a gazillion names, they won't have an annualized return over 7% projected into the future. Bam. There you go. Drop the microphone. Yep. I done did it. So there you go. Let's see. Yep. All right. So I just addressed that. Totally agree. But that's how he does it. No joke. Are you interested in making a YouTube video about traditional banks like JP Morgan? Not typically, because banks trade on book value. All right. So let me very simply explain a bank. Okay. The assets are liabilities. The liabilities are assets. Okay. Liabilities, assets, assets, liabilities. So if you think about it, if you deposit money in the bank, that's an asset to you. That's a liability to the bank because you could take it. Now, you go to the bank, you get a loan. What's that to you? That's a liability. But to the bank, that's an asset. So when you look at a balance sheet, the assets are typically recorded at their historical value and the liabilities are marked to market. That's why you can never look at book value to value a company, just like the equity value on the balance sheet. But guess what, friends? With a bank, not the case. You can do that because it's inverted. The assets are liabilities, the liabilities are assets. So you actually have the assets being marked to market in the case of a bank. So the simplest way, and I've known a bunch of people that like their whole career was investing in banks, like little community banks, commercial banks, stuff like that. Simple methodology, price to book value of less than 1. If you're buying something at a price to book value less than 1, you're literally like factual buying it at a discount. So that's why I wouldn't look at banks, because that's the whole methodology. It's as simple as that. So like that's why I wouldn't do it. It's kind of like someone reached out to me about a REIT. They were like, what do you think about ABC REIT? And I was like, let's check it out. And I took whatever their dividend was. I multiplied it by 1 plus the growth rate divided by cost of equity minus the growth rate. And I'm like, here's the value. And it was like pretty close to what the current market value was. I'm like, it's not that hard. It's pretty like simple and straightforward. So that's kind of the long and short of it. That's why I'm not really interested in banks. I would say focus on smaller banks. That's where you're going to kind of find more value. But yeah, it's that's why I wouldn't do one on JP Morgan. Yeah, Tesla and Palantir. You don't understand disruption. Yep. You can't talk to these people. Honestly, it's like people that like will protest, like political protests. It's like, what are you doing? You don't have a job? Like, you got nothing better to do? Do you honestly think that what you're doing is going to change anything or that anybody cares? No. It's just bizarre to me. Uh yeah. Yeah, that's why the recordings are definitely worth their while, because some of the comments here are absolutely hysterical. They're gold. I totally agree. Um, all right, let me see. I want to make sure I capture everything. Yeah, buying a stock to buying a farm. Yep. Yeah, dude, like what I showed you in Excel is exactly that, and I totally agree. But again, people don't think like that. You know, if you invest the way Buffett does, which very few people do, and you said today, if I left planet Earth and I came back in 20 years, what are people still going to be using? What's still going to be popular? And you just list out all of those things. You would want to know that they're being run conservatively and it's like a no-brainer type business. So like think about him, Dairy Queen, you know, Wrigley's gum, Snickers bars, you know, Hanes underwear, stuff like that. That's where Coca-Cola, like that's where he made the bulk of his money. You know, it's simple as that. Do you think if Buffett started out today with lower capital, he'd be able to replicate his performance? I honestly think he might even be able to exceed it, because people are so focused on like Palantir and Rocket Lab and all this other stuff. There's so many stocks out there that, and he didn't have the information back when versus today. Like he was using the S&P stock guide. It was producing the financials, and it was sent out like every year. And he was able to look at companies. There's a classic case. It was like a fire retardant company, and he was able to buy the company for less than net cash. Like stocks don't trade like that. The market's way more efficient today. I think Buffett shifted to this formula later in his career. In his early days, he used the Graham's net current asset value, like if it was less than 2/3 liquidation value. So let me actually, I'll put that on the screen too. We got a good group here tonight, folks. We got a really good group here tonight. So just to explain the net current asset value concept, you take cash, accounts receivable, and inventory. You multiply cash by 100%, accounts receivable by 75%, inventory by 50%, and then liabilities, total liabilities, okay, not debt, by 100%, okay? So you multiply all of these out, all right? You subtract the liabilities from this total, okay? So I'll put a little border there. Excel, very valuable. This would be your net current asset value, okay? So you're basically taking the cash plus AR plus inventory minus total liabilities. This is how Buffett made his chops early on, all right? So these were called net nets, all right? And he was able to find companies that were like this. So this is like that moron that went nuts on, you got to check the comments out, guys. Seriously, if you want to laugh, go look at the Tesla video. Bronciato or something was the guy's name. And he like went off. He like lost his mind. He said that Tesla should trade based on this. Tesla should trade at net current asset value. It was like the most bizarre thing I've ever seen. I'm like, where do these people come from? They like, I don't know who lets them out. But you know, so that's what he started his career with. So when he met Charlie Munger criticized Warren Buffett and said, why are you investing in cigar butts? And he's like, what? He's like, a cigar butt. Like if you're walking down the street and there's a cigar butt, you could pick it up off the ground, light it, and there's a few puffs left, but that's it. And that's what Warren Buffett was investing in. And that's what he learned from Benjamin Graham. So then he was like, well, what should I invest in? And he said, find companies that have an enduring competitive advantage, that have a competitive moat that will last forever. That's the company you want to invest in because it's going to keep compounding. That's when he switched his whole investment strategy. And that's when he invested in American Express, Washington Post, Coca-Cola. And like you can go back, I would encourage you guys to check out the Buffett partnership letters. It's fascinating stuff. And you see kind of the evolution from the Buffett partnership letters to Berkshire Hathaway. It's completely it's a complete transformation. But he wouldn't be the investor he is today, and Berkshire Hathaway wouldn't be what it is today if he stuck to that strategy. There are like classic value investors. Really great book. I'll actually pull it up for you guys. If you like value investing, you'd really enjoy this. It's called From Graham to Buffett and Beyond. I highly recommend this book. I'll show it on the screen. Wait for it. I'll pull it up on Amazon here. So this was written by Bruce Greenwald, and it is like, it's a really, really phenomenal guide to value investing. This is the book. Value Investing from Graham to Buffett and Beyond. Bruce Greenwald runs the value investing school at Columbia, which is where basically Warren Buffett learned from Ben Graham. And the funny story is Warren Buffett told Ben Graham that he'd work for free, and Ben Graham said that would be too expensive. But you look at some of these investors, like these are like, you know, kind of like the OG Hall of Famers of investing. Michael Price, Mario Gabelli, Paul Sonkin, and they profile each of their investing strategies, how they use value investing. Highly, highly recommend this. I have it, and it's phenomenal. It's a really, really great book, and it'll give you better appreciation and understanding of how to do it. A Chinese investor has invented a ratio of PE to ROE, and he asserted it's the way Warren Buffett values stocks. PE to ROE. So there's an earnings yield, there's the E over P, but a PE ratio would be a multiple. Relative to ROE, that's an interesting one. So let's say if I took, I guess the question would be at what level would he choose to invest? So if like a PE was 10, and the ROE was 10, that would be 1. I'm guessing he would want the ROE to be very high and the PE ratio to be very low. So there would have to be some sort of inflection point where he's like, I only invest in ones that are below 0.5, something like that. Take care, San. San's got to hit the road. Wow. Shot across the bow. Trump just fired Fed Governor Cook. Yeah, Trump is, regardless of what you think, that guy, like, I don't know if he sleeps. Like, he's a machine. I heard something crazy, like he sleeps 4 hours a night. There's a small percentage of people. I know Steve Schwartzman, they're genetically speaking, there are people that can sleep 6 hours or less a night, and it's the equivalent to like the average person sleeping 8 hours. Like it's like specifically a genetic thing. Like if you don't have it, like you'll know if you can. But yeah, there's a few people that are just like rogues and they don't have to sleep a lot. But Steve Schwartzman has the same thing. He like needs very little sleep. Okay, I see. ROE times 100. Okay. Okay. So take that times 100. I guess the question would be like, what would be the rate? Like when would he decide to invest? I'm guessing like low PE, high ROE. So you probably want to have, like, I'm trying to think, PE of 10 and an ROE of 50. Like that would be a really great investment opportunity because it'd be trading pretty cheap on a multiple basis. But there's got to be some sort of inflection point. But I'll check it out. Sounds interesting. But then you get into the PE ratio, the E part. You know, you want normalized EPS. So my guess is he probably chooses normalized EPS. And it's the same thing with the PE ratio. Is it the current PE? Is the forward PE? So there's a whole bunch. This is interesting. I'd have to ask my Korean friends. I found out that Korean people just sleep about 4 hours. So there is a thing called biphasic sleep. So what some people do is they'll sleep a total of 8 hours over the course of a 24-hour period, but they'll do it in like increments. So they'll sleep 4 hours, like let's say from midnight to 4 a.m., but then they'll also sleep 4 hours on the other side. I don't know if that's what people in like Spain do because they do like siestas and stuff. Maybe it's similar. Um, okay, so the PE over ROE below 0.5. Yeah, I could see that. So if you had a PE ratio of 10 and you had an ROE of 20, that would be 0.5. Yeah, that would be a good investment because if you jack up the ROE, then you'd get below zero point 0.5. Yeah, that's an interesting metric. That's the type of thing you would use for screening. And it's good to get a starting point. The thing you got to be careful of with screening is you'll get a lot of financial services companies for obvious reasons. We talked earlier, banks trade at low multiples. So you end up getting a lot of examples of like banks. Like you'll find asset management firms. Like you'll literally find like funds. And it's like, what is this? It's like a mutual fund, like you're not going to invest in that. Um, Good question. Would you recommend taking SIE Series 63 before an IB gig? Um, I would not. You'd think it makes you more marketable, but in reality, they're going to put you through the training anyways and pay for it. And like, it's kind of par for the course. So when you do your like entry into banking, like everybody's going to get it. The only way it would be an advantage is if you were off cycle. So if you were graduating in December and you were starting in January before everybody else starts, then it would be a tremendous advantage. But if you're graduating like on cycle with everybody in like May, June, and you're going to start like June, July, there really wouldn't be much of an advantage. Also, with the licenses, you have to hang it somewhere. So that's the other challenge. Like you have to hang the license, like you basically have to be sponsored effectively. So it's like you need a place to hang it. But I think if you were off cycle, it would make more sense. I would be a bigger fan of going through level 1 of the CFA before you graduate. That would be smart if you ever want to work on the buy side. And most people do investment banking so that they can end up on the buy side, either private equity, hedge funds, etc. That would have value for sure. Yeah, that's something I would definitely recommend. Ah, winding down. We're winding down. We had a pretty cool AI discussion there. We're all over the place. That's what the live stream is all about. You come in with one thought process, you leave with a whole other one. Cool stuff. Yeah, no, I'm still going, man. Still going. Yep, still live. Yeah, we were waiting for you. You made a comment. We're just like, we need to finish up the next point. Yeah, all good, John. Got you, bro. Yeah, if you guys have any questions about like investment banking, getting jobs in finance, like that's really my bread and butter. All the YouTube channels like hyper focused on stocks, because when getting a job on Wall Street is like a hyper niche thing. Once you have the job, it's kind of like you wouldn't need to watch Ken Freeman CFA anymore. But yeah, I could totally give you guys advice on that if you have any questions with that. Always happy to do so. I'm here for you, man of the people. All right, guys, few more minutes, unless we get some really good questions and keep the train going down the tracks. But yeah, I like doing this. This is cool because I get to hang with you guys. You know what? I got a question for all of you. So as we continue to grow this movement of rational, logical, non-emotional thinking, where I'm kind of bringing Wall Street to you, if you have any ideas of things I could/should do, either topic-wise, video-wise, to grow the channel, I am all ears. I am all ears. Any of your thoughts? I know some of you, after last week, I was going bonkers. You were like, you should do reacts videos. Someone was going to send me stuff on like Instagram. They're like, I can't send it on YouTube. They always knock it down. But that's something I'm always open to as well. There's a lot going up top here. See, I'm knocking over the microphone. A lot going up here. So I could just drop it like it's hot. Whatever you guys want. Boom. Summer's almost over. Went really fast. Wild. And then we'll see what happens when we get back. And then what's going to happen? Powell's going to cut rates. Trump fired Cook. Adios. So it'll be interesting to see how it all progresses. But you do have to say, like, regardless of what you think about Trump, the team behind him, like Scott Bessent, dude, that guy is a freaking genius. That guy, when you hear him speak and how like articulate he is and just intelligence, economics, finance, like that guy is awesome. Like he's see this is the one thing I've got to give credit to the current administration. They're taking people from industry. They're not taking a bunch of political hacks and throwing them into these, positions. They're actually taking people that have the freaking experience and they're putting them, in government. So that's good stuff. Ooh, Jason, there's an idea. Calling out CNBC hype would be good content. I could literally just do videos like forever on Jim Cramer just being completely wrong on so many things. I've heard there's like Twitter groups that they basically take what he advises to buy and they short it. And it actually does like really well, like beats the market really well. It'd be cool if you could make learning focused like CFA level 1 videos. Yeah, I could do that with like the learning outcome statements. So what I got to do is like there's different content buckets. So it's like Monday's live stream, Friday's the stock video, and then I've got this like area in the middle. So in the very center part, like Wednesday, that's where I'm thinking of doing like timeless content, where I cover like the financial crisis or confirmation bias, which is like one of, I think, the most rampant behavioral biases. Like it's insane. So what people will do, confirmation bias is fascinating. What people will do is they'll have a thesis. I love Tesla. I hate Tesla. And they will only find information that confirms their position. It's bizarre. So someone wants to buy a particular stock, they will literally just find all the different reasons to do that and that alone. And they will just totally disregard anything else. Like I have a buddy, he's always like negative on the market. He's like, oh, market's going to go down. It's going to go down. It's going to go down. And it's like, you could show him an innumerable amount of data, like to the contrary. And it's like, yeah, but it's going to go down. It's like it's gravity. Like what goes up must come down. It's like pretty much goes up the vast majority of the time. I totally agree. Besson is a legend. People need to listen more to him. Every time I hear that guy speak, it's just like mind blown. Like you just realize how on the ball this guy is. I mean, like if you're in the US, like that guy is a major asset. And he recognizes the debt is freaking out of control, thank God. Instead of just like printing more money, it's like, dude, we got to get our arms around this. And thank God somebody's doing that. All right, CFA level 1 videos are needed. Okay, interesting. All right, so I've got some opinions there. Yeah, dude, I'm not joking, man. There's an inverse. I gotta find it. It's somewhere on Twitter. There's like a few different like Twitter hordes that like they literally just track and index that shorts Kramer's ideas. No joke. Dude, most investors are too biased. That's also like, so we had earlier the people being overly emotional, the Tesla and Palantir investors, and most investors too biased. Absolutely. So here's the fascinating thing. Warren Buffett and Charlie Munger, they literally think of every reason not to do something. And then if they can answer all of those reasons, then they move forward. Everybody else does the complete opposite. They come up with 1,000 reasons why they should invest in something. Palantir, it's going up. It's going to continue going up. But it's like anything to the contrary, like they don't think about. But the interesting thing is, like if you invert it, there's very few things you would ever invest in. Very few. If you came up with all the reasons not to do it, think of how few things you would ever invest in. Very few. Ooh, there you go. The valuation training program you mentioned previously. That's a good one. So yeah, I'm actually going to be doing an advanced financial modeling. It's a financial modeling accelerator over 12 weeks starting October 1st. If that is something you're interested in, put a comment on the video when I post it, this video when I post it, and I'll connect with you and I'll tell you more about it. But basically, if you want to learn how to build financial models, every financial model you can imagine, just like we do on Wall Street, literally like I teach all the investment banks, that will be it. And it's not going to be some template garbage or like, it's literally build it from scratch from a blank spreadsheet. That'll be fire. So if you're interested in that, just pop a comment to that effect once this live stream gets posted. But yeah, that I do every 6 months. It's a 12-week, like hardcore intensive weekly, Thursday evenings, and it's all recorded and everything, so you have full access to it. But if you want to learn like hardcore financial modeling, all the shortcuts, everything, that would be the way. I'm not gonna throw salt on the companies that we all know about that exist. That stuff is pure garbage, pure garbage. Like when I do the trainings for these banks, like you're talking about, they pay 5 figures, yours truly. So that's something that tremendous value, tremendous value. How do you get out of confirmation bias after getting into the position? Seems difficult for me too. Think of all the reasons why you shouldn't do something. It's like literally come up with all the reasons you should, all the reasons you shouldn't, and you have to answer all the reasons you shouldn't. Like Warren Buffett says, like the biggest factor in his success is saying no to the vast majority of opportunities. I'll give you a perfect example. So think about building wealth, right? What do people do? I'll tell you what people do. Shiny object syndrome. So it's like crypto. Then it's going to be some AI tool. Then it's going to be quantum computing. But you never actually stick to the thing. So, I mean, look at the YouTube channel. I did my first video ever in like the very end of 2023. So there were like a gazillion times I should have just said, screw this, done. But I had the mindset like, I'm never stopping. I'm just never going to stop. So it's like your success is guaranteed. Now there's ways you can amplify it. Obviously, if I do level 1 CFA videos, but at the end of the day, if you have that mindset and you just commit to it and you're like, I'm just going to do it until it succeeds. Now, there are certain things structurally, like if you have that mindset with a typewriter business, it doesn't matter. Like, I'll never stop. It's like, dude, you'll wish you had. But if you take something that like from a trajectory and a thematic perspective, like YouTube's not going away, it's going to be, bigger, more powerful, more valuable in the future. It's like, that's something you would want to get on that train. Kind of thing. But yeah, confirmation bias is tough. I just finished the SAT. I feel like I'll be rejected by Rutgers. Oh no. Now, all kidding aside, Rutgers like is very difficult to get into. Like very difficult. I think I told you guys this stat last week, but the average SAT, I'm specifically talking about the business school, not overall. And that is also an option you could apply. There's like different schools you could apply and then transfer. But average SAT score, Rutgers Business School, 1420. I was like, holy crap. And the acceptance rate is 1,100 accepted from 28,279 applicants. So very difficult. And I think the wait list is like 3,000 or 3,500. So it's getting tougher to get into. So it is difficult. But I would say, like, hindsight being 2020, if you're going to invest in like an SAT prep, it's 100% worth it. Like there's some out there that guarantee you're going to get 100 points higher or your money back when you take it next. Do it. Like I didn't realize when I was applying to colleges like how important the SAT was. Dude, no joke, I was valedictorian of my high school class, and that didn't even matter as much as the SAT. There were people that were like C students that like blew out the SAT, and they got like more scholarships and stuff. So yeah, okay, that's not very high. I'm talking on a 1600 scale, not whatever it is now, 2300 or 2100, whatever it is. Yeah, NYU Stern, 1500 plus. Yeah. Yeah, it's crazy. It's crazy competitive. And then you got the people that are like, you don't even need to go to college. I don't know if we're there yet. You could go to into a trade, like, yeah, then you definitely don't need college. But I think especially, business, they're saying Jamie Dimon, like, we'll hire people from high school and stuff. I don't see that happening anytime soon. But like, if you're like a rock star, like there was some kid I read about, his last name was like Wagyu. Like I kept thinking of Wagyu beef. But he's like some AI wizard and they're trying to hire him at Meta, and like he was in high school. There are kind of like uh, weird cases like that, but regular folks like us, I don't think can count on that. All right, friends. So I'm going to cut it here. Appreciate all of you. Definitely keep spreading the word. And don't forget to check out the video this week, Friday, 6 a.m. And I will see you same time next week, and tell everybody about the channel, the movement. I'll see you guys later, and make lots of comments. Take care, everybody.